Yeah, good morning, everybody. Today, being Saturday, the 20th of August, where we'll continue with our session. And today, we'll be looking at an aspect of group adjustments. Okay, and as we discussed earlier, in order to more or less make a group account, we said the group account is the account of the parent and that of the subsidiary, as if it's an account of a single economic entity. And what depicts is that consolidation of the accounts or results of the parent with the subsidiary goes beyond a mere addition or line-by-line combination. There are some adjustments that have to be made in order to reflect a single economic unit concept. And a single economic unit concept is saying that assuming they are actually one, which means they has been fused into one another as a single entity, what the result will have been is what we want to mimic. And what that means that we need to identify intra-group transactions, or what we call intercompany transactions, which may necessitate one or two adjustments in order to reflect the single economic position. And those are the things we'll be looking at today. And in doing that, we'll more or less look at our material to give us some level of guidance. And in our material, we'll be making relevance referral to chapter 9 of the material, in which we'll have extensive discussion on. And in this case, we are at the chapter 9 of the material, and I want somebody to more or less, okay, I will probably read the introduction of the chapter, and we'll start our discussion extensively in this manner. Okay. Now, to do that, I'll more or less enlarge what I have before me and try to make 1 or 2 meaning out of it. Now, in this chapter that we'll be looking at, what we'll be talking of extensively borders on we have an understanding of the requirement of IFRS 10 with respect to group accounts, and all intergroup trading and the effect thereon will have to be eliminated, okay? And also, in addition, any intragroup balances must also be eliminated. And this is to show the result of the group as of a single economic entity. Now, the chapter will further consider the effect of intergroup trading and its elimination with respect to how we reflect income, expenses, assets, and liabilities, including equity, such that overstatement or understatement are eliminated in all ramification. Also, in the course of the discussion, effect and treatment of intergroup balances where they don't necessarily cancel out. When I say that, that means where we have imbalances between what the parent might claim is having as receivable from the subsidiary and what the subsidiary might claim is having as payable to the parent. What could bring about this, we identify them, which is not limited to things like cash in transit or goods in transit. Another aspect that we'll also look at are situations where a subsidiary more or less pay dividend within the group, and the dividend becomes a liability to the subsidiary upon declaration, and it becomes an asset, which is a receivable to the parent upon declaration. The question then is, how do we more or less treat this situation in the balance sheet of the group vis-a-vis the portion of the dividend that might be ascribed to the non-controlling interest? All of these are things that we are going to take into consideration. Now, to do that, I want someone to more or less take a look at some things that will introduce us to all of our discussions today, where we'll be dealing extensively with intra-group transactions. Okay? Who will volunteer?
Adjustments to group account. It is not an aberration to acquisition for the parent and the subsidiary to carry out series of transaction with one another, which is usually considered and referred to as related party transaction. This transaction may or may not be effectual at arm's length and may disrupt the true financial position and performance of the individual entity, and also consider the parent and the subsidiary from a single economic unit requires the need to eliminate such transaction. Intergroup transaction or intercompany transaction must be eliminated. A situation might exist where the parent sells some items of inventory to the subsidiary at a cost or with profit loading, and this transaction might not reflect the economic status. It is required that upon consolidation of the account of the parent and subsidiary, balances due or to or from members of this group should also be eliminated, that is cancelled out against each other alongside relevant adjustment for unrealizable profit or losses. The rationale for the elimination of intercompany transaction within the group is to avoid the possibility of grossing of the financial statement for transaction and of balance that do not represent economic events with outside parties. The non-existence of the principle of elimination of intergroup transaction and balance in preparing consolidated financial statement might misrepresent it. The true financial position and performance, where the group entity will be seen to be larger than it is in reality, which is attributable to multiple transactions with itself, parent and subsidiary. The adjustment required on consolidation can be observed to be upstream transaction or downstream transaction, which need to be eliminated from the consolidated financial statement in order to avoid duplication in the accounts. Some item may surface in the statement of financial position of the parent or subsidiary as an asset, while simultaneous as a liability in the financial statement of the subsidiary or parent. Invariably, for consolidation purpose and to deplete the economic power or substance of the consolidated financial statement, intra-group or inter-economic balance are better reported net, that is netted off, cancelled out. The intercompany transaction and requisite adjustments include are not limited to the following: unrealized profit on the sales or transfer of goods within the group, unrealized profit on the sale or transfer of assets such as property, plant, and equipment within the group, intercompany current accounts balance, intergroup, intercompany accrued or prepaid expense and income, intergroup, intercompany loans, intergroup, intercompany accrued interest on loan, intergroup, intercompany bills of exchange and discounted bills treatment, increase in shares of subsidiary as held by parent with no additional cost incurred, that is bonus issue, treatment of dividends required and received and unreceivable from subsidiary. Downstream transaction for consolidated purpose can be considered as a transaction emanating from the parent to the subsidiary or associate joint venture. Upstream transaction for consolidation purpose can as transaction emanating from subsidiary to the parent or associate joint venture to the parent. The transaction, okay.
Okay, now that is that. What we are trying to say is this. Let me share my notes with you. Now, if you recall, we said group accounts is the account of the parent and the account of the subsidiary. I've said this is the account as if is account of a single economic unit, or what you can call entity. Now, if we break this down further, we can say group accounts is the account of the parent plus the account of the subsidiary plus or minus group adjustments. Now, it is this that somewhat produces okay, now breaking it down, we could say group account is the account of the parent plus that of the subsidiary plus or minus group adjustments. Okay, now this is when we can perceive that we have produced group accounts as of a single economic unit. Now, in this case, we'll focus our energy on group adjustments. Now, what constitutes group adjustments? We've started some group adjustments as part of what we call the consolidation mechanics. Some of those adjustments we started with then were principle of cancellation and how we measure non-controlling interest, and also how we attribute reserve of a subsidiary subsequent to acquisition into pre-acquisition reserves and into post-acquisition profit or loss. But now there are other extensive areas of group adjustments that we'll now touch base on, and this is triggered the group adjustment we are talking about are triggered as a result of intra-group, or in some quarter, intercompany transactions. Now, in this context, intra-group or intercompany transaction are restricted to that between the parent and the subsidiary. We are not going to use it loosely in the likes where everybody call intercompany, so that when you are not even parent and subsidiary, but you are just an affiliate, sister entities, related entities, you say intercompany balance. But here we are restricting it specifically only to transactions between the parent and the subsidiary. And since we don't know what the parent stands to be, I will know who subsidiary is to the parent. Therefore, that is the only context to which we make our expression. Which means that we should not, in any context, misconstrue this to mean any form of transaction or balances between related parties. No. It's between the parent and subsidiary. And related party is much more extensive beyond just parent and subsidiary. And that's why we're going to take that into consideration. Now, what are the transactions that may occur in this regard? Intergroup transactions may entail any of the following. The most common one is the one that entails sale of goods. That is one party selling to another within the group. And take note, it is ability to relate with one another as a parent and subsidiary by way of transactions that creates synergy. One of those synergies is this. Imagine the parent and subsidiary are in the same line of business, but they are only geographically different with respect to the market, which means the parent is much more strong in the south, and the subsidiary, before becoming the subsidiary, was strong in the north. And in order to have presence in the north, the parent has chosen to acquire the subsidiary. In doing so, one of the benefits you are going to try to create is economic of scale in your buying power. And what does that mean? Imagine you are a merchandise as a parent and your subsidiary is also a merchandise, which means a trading company. What do you guys do is that you buy and you sell. You buy in bulk and you sell in retail, for example. Now, what then you could do is that instead of you to continue individually before the acquisition the way you do, by the parent sources for its own products and subsidiary sources for its own product, what then you could do is that you can build economic of scale by the parents buying on behalf of everyone. And therefore can create a synergy where you have a good bargaining power, which can translate to good terms, which also translate to good discounting that brings about reduced pricing. Now, in doing so, the parent then can have transfer those goods to the subsidiary at agreed time. The lowest of the time might be at cost. But because they are two separate entities and they are expected to also deal at arm's in one regard or the other, sometimes or most times the parent may transfer at a profit. Therefore, all of these are interactions, exchanges that take place within the group in order to create value. Therefore, as we look at that, we can also look at things that borders on sale or transfer of assets, most especially tangible assets, but it's not limited to tangible, it could also extend to intangible assets. Now, where the parent might transfer his property, his plants, or vice versa, the subsidiary can either do so. Okay, where you have management services within the group. And what does that constitute? The parent might more or less warehouse certain common services with respect to support services or corporate services. And in that light, all of these are maintained in the group, to which there is a basis of allocating cost or charging back to one or two or more subsidiaries within the group. And this also will constitute intercompany transaction. Another one that is much more common with respect to treasury and financial management is financing arrangement. Within the group. Okay, in financing arrangement within the group, what this connotes is that within the group, you could have a surplus unit and you could have a deficit unit. A surplus unit is a member of the group that more or less have positive cash flows, okay, or what we call excess cash flows, which are idle, and the best opportunity is to place them in short-term security in order to earn return rather than making it idle. And the deficit unit is the unit where it needs more funds for working capital management. And in this regard, it's much more possible within the group, as one of the ways of enhancing value is for the surplus unit to lend to the deficit unit. And this creates intra-group borrowings or intercompany borrowings. And this is one of the ways to which you enhance value within the group. Okay. Now, let me write it one. Another one you can have within the group is dividend as a return from the subsidiary. Okay, what this signifies is that the subsidiary at the end of the day is to pay dividend to shareholders. And don't forget, the majority shareholder in most respects is the parent. And in that case, how do we account for that within the group? And many more others, but we'll limit it to our discussion to this, and we'll pick them one by one on how they impact the financial statement of the group as required. Now, what you observe most times is as follows. That sale of goods usually triggers adjustment for unrealized profits. And we're going to explain when this occurs. Why sale of goods, sale of assets triggers similarly unrealized profit on transfer of assets could depreciation adjustment. And depreciation adjustment is only relevant when the asset so transfer is a depreciable asset. It's not something like land that in most jurisdictions are not depreciated. And our discussion on IAS 16 should speak much more to why land may not be depreciated. Not only that, management services, and these three I've mentioned earlier, may bring about intercompany balance that has to be eliminated. Therefore, elimination of intercompany balance. Remember, intercompany balance may constitute receivable and payable on the premise that transaction has taken place, but cash has not fully exchanged hands. Borrowing. We also create elimination of intercompany balance between the lender, who is a party in the group or a member of the group, and the borrower, who is also a member of the group. Now, also in carrying out intercompany balance, sometimes, especially as it relates to sale of goods or transfer of asset or management services, there can be further adjustment that relates to goods in transit and sometimes cash in transit. Okay, finally, this requires us to eliminate intercompany balance with respect to dividend receivable and dividend payable. And furthermore, where there's non-controlling interest who has entitlement to some aspect of dividend, the balance left will be accounted for as a liability of the group to non-controlling interest, which will be shown usually within current liability section of the balance sheet of the group. But all of these adjustments are what we are going to look at one after the other. In order to have a better understanding and appreciation of what it is. Okay. Any question before we move further? If there are no questions, okay. Let us now look at this. Okay, now let's start with unrealized profits. And who will take this up on our behalf? Unrealized profits. Who will read it up?
Unrealized profits on inventory. The transaction between the parent and the subsidiary as regards sales of items of goods to each other are usually carried out with some element of profit embedded. It is initially assumed that the goods sold or transferred to other entities within the group will eventually be sold before the year end of the entity or the parent entity, when the reporting date differ, but this may not usually be the case as some of the goods may remain unsold by the other entity. The entity that make the purchase to third party as at the end of the reporting period for the group. The profit earned by entity that sold the goods to the other within the group would have been recognized as profit on the sales in its individual financial statements. This profit will be considered on consolidation as unrealized within the group as those goods are not yet sold outside the group, sold to third parties. The intercompany sales of goods may take a form of upstream or downstream transaction. This implies that if inventory of a group member contains goods purchased from another group member, then the carrying value may include a profit element that is all realized from the group perspective. That is, from the group perspective, such profit cannot be recognized until the goods are sold outside the group. Furthermore, sales within the group should only be regarded as a mere transfer rather than an outright sales of goods. But there exists no problem of poor consolidation if all sales made at a profit within the group have been duly sold to other parties outside the group. There exist challenges on consolidation which require adjustment only if the sales within the group are made at profit and not at cost, and a fraction of or all remain unsold as at the reporting date. Scenario analysis to justify elimination of unrealizable profit on inventory arising from intergroup transaction. In this context, we will consider four scenarios: scenario A, B, C, and D, as depicted below. Scenario A: the parent and the subsidiary deal in the same line of trading business, but separated by demography, that is, physical location. The parents operate in the southern part of Nigeria, while subsidiary operate within the northern part of the country. As a result of the economy of scale and on the basis of creditworthiness, much more profitable for the group to centralize purchasing procurement in which the parent company is saddled with. In this year, the parent purchased 10 million liters of diesel, AGO, at a weighted average cost of 200 naira per liter. The parent sold 7 million liters to third-party customers in that year at an average selling price of 220 per liter, and equally transfer or sold about 2 million liters at a cost price to its subsidiary during the year, while the unsold 1 million liters is to constitute the amount of inventory in the book of the parent as at year end. The subsidiary was unable to sell any of the liter diesel in the year due to insecurity situation in the northern part of the country as a result of Boko Haram insurgents. Hence, as at year end, we intend to ascertain the amount of the inventory to be reported in the consolidated financial statement of the group. Individual entities: inventory of parent 1 million liters of diesel, 200 per liter, 200,000. Inventory subsidiary 2 million liters of diesel at 200 per liter, 400. Combined inventory 600. If we consider the situation and assume that the subsidiary only acts as an agent of parent to sell the liter of diesel in the northern part of the country for commission, can the amount of inventory from the parent perspective remain the same? In this case, we reconsider the case, and since the subsidiary has no ability to sell in the northern part of the country due to security situation, then the goods in the first instance would not have been transferred to the subsidiary. Then the liter of diesel unsold will increase in the custody of the parent to 3 million, as only 7 million liters has since been sold as at the reporting date. Parent inventory account: inventory of parent 3 million liters of diesel at 200 naira per liter, that's 600. And then the parent and the subsidiary deal in this. Okay, scenario B: the parent and subsidiary deal in the same line of trading business, but separated by demography, that is physical location. The parent operates in the southern part of Nigeria, while the subsidiary operates within the northern part of the country. As a result of economy of scale and on the basis of creditworthiness, it is much more profitable for the group to centralize its purchasing procurement in which the parent company is saddled with. In the year, the parent purchased 10 million liters of diesel Argo at a weighted average cost of 200 naira per litre. The parent sold 7 million to third-party customers in that year at an average selling price of 220 per litre. And equally Transalt sold about 2 million litres at an average price of 210 per litre to its subsidiary during the year, while the unsold 1 million litre of diesel constitute the amount of inventory in the book of parent at year end. The subsidiary was able to sell all the liters of diesel in the year, despite the security situation in northern part of the country. As a result of the Boko Haram insurgents. Hence, as at the year end, we intend to ascertain the amount of inventory to be reported in the consolidated financial statement of the group. Individual entity level, inventory, parent 1 million litre diesel at 200 naira per litre, 200 naira. Inventory subsidiary 0 litre of diesel at 200 naira per litre. Nothing is there, 200 combined inventory. If we consider the situation and assume that the subsidiary only acts as an agent of the parent to sell the litre of diesel in the northern part of the country for a commission, can the amount of the inventory from the parent perspective remain the same? In this case, we reconsider the case, and since the subsidiary is uncertain of selling the liters of diesel based on Boko Haram insurgents in the northern part of the country, then the goods in the first instance may be sold directly by the parent to the customer, haulage companies, and industries in the northern part of the country, as many as may be assigned by the subsidiary for commission. Then the litre of diesel unsold will likely still remain the same as in the custody of the parent, since on either case the total of 9 million litres would have been sold, as comprises of 7 million litres sold by parent to its customer and 2 million litres presumed sold on the basis of assigned sale by its agents, which simultaneously stand as a subsidiary as at the reporting date. Parent inventory accounting. Inventory of parent 1 million litres of diesel at 200 naira per litre, 200 total 200 million naira. Scenario C. The parent and the subsidiary deal in the same line of trading business, but separated by demography, that is location, physical location. The parent operates in the southern part of Nigeria, while the subsidiary operates within the northern part of the country. As a result of economy of scale and on the basis of creditworthiness, it is much more profitable for the group to centralize its purchasing procurement, in which the parent company is saddled with. In the year, the parent purchased 10 million litres of diesel at weighted average cost of 200 naira per litre. The parent sold 7 million litres to third-party customers in the year at an average selling price of 220 per litre, and equally Transalt sold about 2 million litres at the cost price to its subsidiary during the year, while the unsold 1 million litres of diesel constitute the amount of inventory in the book of the parents at the end of the year. The subsidiary was able to sell only 1 million litres of diesel in the year as a result of the security situation in the northern part of the country due to Boko Haram insurgents. Hence, as a year end, we intend to ascertain the amount of inventory to be reported in the consolidated financial statement of the group. Inventory of parent 1 million litres of diesel at 200 naira per litre. Inventory subsidiary 1 million litres of diesel at 200 naira per litre, 200 naira, 200 million naira. So combined inventory is 400 million naira. If we reconsider the situation and assume that the subsidiary only acts as an agent of the parent to sell the litre of diesel in the northern part of the country for a commission, can the amount of the inventory from the parent perspective remain the same? In this case, we'll reconsider the case, and since the subsidiary is uncertain of selling the litre of diesel based on Boko Haram insurgents in the northern part of the country, then the goods in the first instance may be sold directly by the parent to the customer, village company and industry in the northern part of the country as may be assigned by subsidiary for commission. Then the liter of diesel unsold increases in the custody of the parent 2 million. Since in that case, the total of 8 million liters would have been sold as comprises 7 million liters sold by the parent to its customer and 1 million liters presumed sold on the basis of assigned sales by its agent, which simultaneously stands as a subsidiary as at the reporting date. Parent inventory accounting. Inventory of parent 2 million liters of at 200 naira per liter. That's 400,000 naira, 400 million naira in total. Scenario D. The parents and the subsidiary deal in the same line of trading business, but separated by demography, that is physical location. The parent operates in the northern part of Nigeria, while the subsidiary operates within the northern part of the country. As a result of the economic of scale and the basis of creditworthiness, it is much more profitable for the group to centralize its purchasing procurement, in which the parent company is saddled with. In this year, the parent purchases 10 million liters of diesel at a weighted average of cost of 200 naira per liter. The parent sold 7 million liters to third-party customers in the year at an average selling price of 220 per liter, and equally transferred sold about 2 million liters at an average price of 210 naira per liter to its subsidiary. During the year, while the unsold 1 million liters of diesel constitute the amount of inventory in the book of record as a year end, the subsidiary was able to sell only 1 million liters of diesel in the year as a result of the security situation in the northern part of the country due to Boko Haram insurgents. Hence, as at the year end, we intend to ascertain the amount of inventory to be reported in the consolidated financial statement of the group. Individual entity level, inventory of parent 1 million liters of diesel at 200 naira per liter, inventory of subsidiary 1 million liters of diesel at 210 naira per liter, 210 million naira, combined inventory 410 million naira, which is wrong. If we reconsider the situation, assume that subsidiary only act as an agent of the parent to sell the liter of diesel in the northern part of the country for commission, can the amount of inventory from parent perspective remain the same? In this case, we reconsider the case, and since subsidiary is uncertain of selling the liters of diesel based on Boko Haram insurgents in the northern part of the country, then the goods in the first instance may be sold directly by the parent to its customer, village company and industry in the northern parts of the country, as may be assigned by subsidiary for commission. Then the liters of diesel unsold will increase in the custody of the parent to 2 million. Since on either case, the total 8 million liters would have been sold as it comprises 7 million liters sold by the parent to its customer and 1 million liters presumed sold on the basis of assigned sale by its agent, which simultaneously stand as a subsidiary as at the reporting date. Parent inventory account. Inventory of parent 2 million liters of diesel at 200 naira per liter. That's 400 million. There is a trigger in scenario D as the amount of alert. There's a trigger in scenario D as the amount of inventory at the two purchase instances do not result in the same amount of inventory to recognize in a group account as signified by the. Please scroll up by the two signs, wrong and correct scenario. Hence, it then implies an adjustment to the amount of inventories required at individual entities level, based on which entity sold to the other, and as in the case in the picture, that the parent sold to the subsidiary, then adjustment impacts the overstated amount of inventory in the book of subsidiary vis-a-vis an overstated profit position in the book of the parent as depleted below. Individual entity level, inventory, parent 1 million diesel to 200 per liter, inventory of subsidiary 1 million liters of diesel at 210 per liter. So less unrealizable profit, 1 million liters of unsold diesel at unrealizable profit of 10 naira per liter, which is 10 million naira. So you deduct it, that's 400 million naira combined inventory. The unrealizable profit per liter is 10 naira, being the difference between the selling price of 210 per litre by the parent to its subsidiary, and the average cost price to the parent of 200 naira per litre. In conclusion, the above scenario ABCD would have laid a solid foundation to understanding the need to carry out some adjustment and elimination in group account as a result of intra-group or intercompany transaction and balances. We could further classify the transaction between the parent and subsidiary as either downstream or upstream. Downstream, that is down the stream, or upstream, that is up the stream transaction. Downstream transactions are those transactions emanating from the parent to subsidiary, e.g., goods from 10 million naira transferable sold to the subsidiary. Upstream transactions are those transactions emanating from subsidiary to parent, e.g., goods worth 10 million transferable or sold to the parent. Downstream transactions. This involves the sales of goods to investor goods by their investor, parent to the investee subsidiary. Since the profit is recognized by the parent upon sales of the subsidiary, sales to the subsidiary, the unrealizable profit should be adjusted against the consolidated retained earnings as thus: debit consolidated retained earnings and credit group inventory with the total unrealizable profit.
Thank you very much. Now, all of the four scenarios, we'll summarize it as follows. All of these four scenarios, we'll summarize it as follows. Now, the first adjustment we'll be looking at is unrealized profit. And I'll do that by sharing this, my notes. Unrealized profits on inventory or on sale of goods within the group. Now, there are four scenarios. There are four possible scenarios. Now, let's pick them one by one. Scenario one. Now, in this scenario, let's say parents sold goods to subsidiary at one, at cost, and two, subsidiary was unable to sell any to third parties. What is the implication? The implications are as follows. The first implication is that though the subsidiary was unable to sell to third parties, they're seeing not to be, there seems no unrealized profits since the parent sold to the subsidiary at cost, which means the goods being in the hand of the parent or in the hand of subsidiary is still at the same amount, which is what? The cost. Therefore, no adjustment for unrealized profit is required. No adjustment for unrealized profit is what? Required. And that's the first scenario, which means even if the subsidiary was unable to sell, we won't be required to make an adjustment for unrealized profit because in what was transferred by the parent to subsidiary itself, it was done at cost. And in that case, no need. Let's look at scenario B.
Hello, sir. I have a question, sir.
Okay, go ahead.
Okay, since there is no adjustment, since the parent transfers the goods to the subsidiary at cost, but the parent is still going to report its what's it called in his own books as inventory, right?
No, it's not inventory in the parent's book, it's inventory in the subsidiary's book.
Or in the subsidiary's book at cost.
Yes, yes. Now, at consolidation, we just pick the inventory of the parent and inventory of subsidiary and we add it together. All because there's no adjustment required.
Yes. All right.
Do you get it right now?
Yes, sir. Thank you.
Now, let's look at the second one. Second one, let's say the parent sold goods to the subsidiary at one, cost, two, subsidiary was only able to sell parts to third what? Parties. What will be the issue? The implication will not be far-fetched from what we've done before. One, no adjustments for unrealized profit is required, regardless of whether the goods are wholly sold partly sold or what? Unsold. In this case, it was partly sold, which means the portion unsold, that is, in this case, the portion unsold will still not trigger or require an adjustment for unrealized profit, which means What these two scenarios has proved to us is that whether you have sold, you have unsold, and you are partly sold and partly unsold, once the transfer price between the parent and subsidiary is at cost, it will never trigger any adjustment for unrealized profit because there was no even profit in the first case. Therefore, what are you now trying to eliminate? Nothing. You can say now, if you have not given me any money, and two of us have a fight or quarrel, I say, give me back my money. I'll ask the question, which money? Can I give you back what you didn't give to me? No. But if you have been assisting me and you just gave me money some hours ago, and we fought now, I say, give me back my money. Because you've given me that money, probably you have a right to say, okay, give me back. And in that case, I can say, okay, I'm sorry, or you can say now, which means in this situation, there's no realized profit to give back or to eliminate because in the first case, there was no profit loaded in the transfer price, or because the transfer price between the parent and subsidiary was at cost, and this will not have triggered unrealized profit. Now let's look at scenario C. Now in scenario C, let's say the parent sold goods to subsidiary at cost plus profit loaded, which means the transfer price is no longer cost, it's cost plus profits. Similar to what any independent party will have done. Because there's no free lunch, even in free town. And in this case, the subsidiary is so efficient that the subsidiary has been able to sell all of those goods all of the goods to third parties. In this case, what are the implications? One, though the parents loaded the transfer price with profits, but fortunately, luckily, the subsidiary was able to sell all to external customers. Hence, the profits will all have been realized. Therefore, whether profit was loaded or not, no adjustment is required. Because the subsidiary has been able to transfer the burden to third parties. In that case, which means whenever subsidiary or any other party in the group has been able to sell all of the goods to which the other party has transferred to it at a profit, there's no cause for alarm. Because what is a burden to a subsidiary which was put upon it by the parent, the subsidiary has successfully pushed that burden to others who are not members of the group, which then means that technically realization of those profits has been made. Now let's now look at the last scenario, which stands out from others. The last scenario is, I'll put it in red so that what triggers adjustments. Let's say the parent sold goods to the subsidiary at 1, cost plus profit loaded, but the subsidiary has only sold part to third world parties. Therefore, what are the implications? Where the parent has sold goods to the subsidiary at a transfer price that includes profit. There would be an unrealized profit whenever the following occurs. What are the following? A, the subsidiary was unable to sell any of the goods to third parties. B and B, the subsidiary was unable to sell parts of the goods to third parties. Which means what we are trying to say is that even if it's only one unit you're unable to sell, or the entire unit you're unable to sell, there's an element of profit in those units, whether a unit or in those units that represent profit loaded by the parent, which the parent has not yet realized. And in that case, it will trigger This will trigger an adjustment for unrealized profit. And that's what we saw in the first scenario. And I want somebody other than Mrs. Abdul to read, because she has taken her time to read. We'll go back to the first scenario, that is scenario D, and look at the scenario and see why that was the only scenario that triggers unrealized profits. Scenario D. Who will volunteer?
Scenario D.
Okay, sir. Thank you.
All right.
Yeah, continue.
Okay. The parent and the subsidiary deal in the same line of trading business, but separated by demographics. The parent operates in the southern part of the Nigerian, while the subsidiary operates within the northern part of the country. As a result of economy of scale and on the basis of credit worthiness, it is much more profitable for the group to centralize its purchasing and procurement, in which the parent company is saddled with. In the year, the parent purchased 10 million liters of diesel ago at a weighted average cost of 200 per liter. The parent sold 7 million liters to third-party customers in the year at average selling price of 200 naira per liter. They and equally transferred in bracket or sold about 2 million liters at an average price to 10 per liter to each subsidiary during the year, while the unsold 1 million liter of diesel constitutes the amount of inventory in the books of the parents as at year end. The subsidiary was able to sell only 1 million liters of diesel in the year as a result of the security situation in the northern part of the country due to Boko Haram insurgents. Hence, as at the year end, we intend to ascertain the amount of the inventory to be reported in the consolidated financial statements of the group. Individual entities level. Inventory of parents, 1 million liters of diesel at 200 naira per liter, equal to 200 million naira. Inventory of subsidiary, 1 million liters of diesel at 210 naira per liter, equals 210 million naira. Combined inventory, 410 million naira. If we reconsider the situation and assume that the subsidiary only acts as an agent of the parent to sell the liters of diesel in the northern part of the country for a commission, can the amount of the inventory from the parent's perspective remain same? In this case, we consider the case, and since the subsidiary is uncertain of selling the liters of diesel based on the Boko Haram insurgents in the northern part of the country, then the goods in the first instance may be sold directly by the parent to the customers, in bracket haulage companies and industries in the northern part of the country, as may be assigned by the subsidiary for the commission. When the liters of diesel unsold, then the liters of diesel unsold will increase in the custody of the parent to 2 million naira, since on the either case, the total of 8 million liters would have been sold as it comprises of 7 liters sold by the parents and a liter sold by the subsidiary on the basis of assigned sales. Sorry, my screen is small. Okay. All right, let me take that again. Then the liter of diesel unsold will increase in the custody of the parents to 2 million. Since on either case, the total of 8 million liters would have been sold as it comprises of 7 million liters sold by the parents to each customer, and a million liters presumed sold on the basis of assigned sales by its agent, which simultaneously stands as its subsidiary, as at the reporting date. Parent inventory accounting, inventory of parents, 2 million liters of diesel at 200 per liter. Alert, there is a trigger in scenario D, as the amount of the inventory at the two portrayed instance do not result in the same amount of the inventory to be recognized in the group account as signified by the as signified in the above. Hence, it implies an adjustment to the amount of inventory is required at individual entities level based on each entity sold to the other, and as in its case, it is a picture that the parents sold to the subsidiary. Then the adjustment imparts the overstated amount of inventory in the books of the subsidiary vis-a-vis. Sorry, my screen is so small. I'm trying to adjust. Okay, vis-a-vis an overstated profit position in the books of the parent. As depicted below, individual entities level, inventory of parents, 1 million liters of diesel at 200 200 per liter, 200 million naira. Inventory of subsidiary, 1 million liters of diesel at 210 per liter, 210 million. The less unrealized profit, URP, 1 million liters of unsold diesel at URP of 10 naira per liter, which is 10 naira negative. A total combined inventory of 400 million. The unrealized profit per liter is 10 naira, being the difference between the selling price of 210 per liter by 210 per liter by the parents to the subsidiary, and the average cost price to the parents of 200 naira per liter. In conclusion, the above scenario A, B, C, and D would have laid a solid foundation to understanding the need to carry out some adjustment and elimination in group accounts as a result of intergroup or intercompany transactions and balances.
Thank you very much, sir. Now, this will emphasize what we've discussed earlier. Now, let's pick examples to depict, let's pick questions to depict our understanding of this. Okay, I want you to read this question, sir. Illustration 1.
Pali PLC acquired 160 million of the shares of Susi PLC when the reserves were 20 million naira. During the year to 31st December 2015, Pali PLC sold goods costing 10 million at a profit of 20% on the cost to Suzy PLC. As at the reporting date, only 40% of these goods were sold to external customers by Suzy. In the same period, the statement of financial position of the dual companies as at 31st December 2015 is as follows. Statement of financial position as at 31st December 2015. Assets, Pali and Suzy. Non-current assets, profit, property, plant, equipment, investment in Suzy PLC, 110 million naira. Then in Suzy, in Pali, 110 million naira, in Suzy, 120 million. Investment in Suzy PLC, Pali, 100 million naira. Current assets, inventories, 40 million naira in Pali and 45 million in Suzy. Okay. All right. Contemporaneous accounting for business combination and group accounts. Accounts receivables, 15 in Pali and 12 in Suzy. Bank, 5 in Pali, 7 in Suzy. Total assets, 270 in Pali and 184 in Suzy. Equities and liabilities. Equity, ordinary shares at 50 naira per share, 80 million in Suzy, 100 in Pali, 100 million in Suzy. Retained earnings, 140 in Pali and 60 in Suzy. Current assets, 50, current liability, 15 in Pali and 24 in Suzy. Total equity and liabilities, 270 in Pali and 184 in Suzy. We are to approach the solution in the following steps. Step 1, determine the percentage holdings of investment of Pali in Suzy as at the acquisition date, same date ago, which represent the date of inclusion, in bracket, first date of consolidation. In this case, the percentage holding is determined and ascertained to be 80%. The 80% interest of Pali is ascertained by expressing 160 million shares as a,
Thank you very much, sir. We'll start solving the problem now, which I've transcribed to, I've brought it down here. Okay, what are we supposed to do now is for us to, we are required to consolidate as a reporting date, which in this case is that 1st December 2015. Okay. Now, what can we do? In this case, we are not given the percentage. We are only told that Pali acquires 160 million shares in Suzy. Now, the question then is, if the parent acquires 160 million shares, The question then is, how many shares are in subsidiary in all? How many shares are in subsidiary in all? Okay. In that case, what can we do is to find one. What is the share capital of subsidiary? And the share capital is 100 million naira. Okay. 2. What is the nominal price per share? In the question, the nominal price per share is 50 kobo. I come here, 0.5. Let me enlarge it. That's 50 kobo per share. Hence, subsidiaries shares issued will be, let me call this A instead of this asterisk, and let me call this B instead of these two asterisks. Then it will be A divided by B. And what is A divided by B? A divided by B in shares will be 100 million divided by 50 kobo per share will give me 200 million shares. Therefore, the percentage holdings of PALI is what? Is the ratio of what he acquired, 160 million shares, out of what is total 200 million shares. And that's how we're able to get the 80%. Let me put it here. That's how we're able to get the 80%. Now, I cannot transfer the 80% here to say this 80%. Why am I doing that is because imagine we are told that it's 150 shares that was acquired. It will have given me 75%. And that will change automatically and my NCI will become 25. Okay. And that is that. Now, we've been able to determine that. Let's go back to this and draw up our chart. That's our group structure. What is a group structure? The group structure PALI acquired Suzy 80%, NCI is 20%, date of acquisition, and date of consolidation. Now from the information, we're not given date of acquisition, which means it was some time ago, and we are reporting as at 31st December 2015. Therefore, I can cut this off. And paste it. I'll cut it off and paste it on our Excel spreadsheet. Now we are back at our Excel spreadsheet. There's somewhere here. Let me put it here. Okay. Now we need to separate our reserve into pre and post. Our reserve as at acquisition was set to be 20 million. 20 million. Our reserve as at the end of the year reporting date was 60 million. And our model will throw out what is our post-acquisition profit or loss, which in this case now is profit of 40 million. Investment in Suzy was set to be 100 million. Ordinary share capital of Suzy was set to be 100 million, which we have here. And that's the 100 million. I can link it to what we have here. And our pre-acquisition reserve is 20 million. Therefore, I can link this to this. Okay. All things being equal, we are setting up our games. Now, in this case, we'll look at the two possible scenarios, given that we measure our NCI at fair value. Okay, there's no fair value here. We don't even have that. Therefore, it's only one scenario. Therefore, I take this out. Sorry. Okay. Which means this is not there. Okay. Now, in this case, what happens? We'll determine whether we have goodwill or not. Our purchase consideration was 160. Oh, sorry, 100, yeah, which is here. I'll link it. NCI will be measured later. So what's the ordinary share capital of Suzy, the subsidiary? The ordinary share capital of Suzy is 100 also. And pre-acquisition reserve is 20. Which means the kind amount is this. There's no fair value adjustments. Fair value adjustments. At acquisition. In In this case, it is nil. That means we presume that all of the assets and liabilities have the kind amount being a reflection of the fair value. Okay, therefore we can value NCI. The percentage of NCI is 20%, if you remember. And the net asset here is 120. Therefore, 20% of 120 is what we already have here, 20% of 120. That's 24 million. Therefore, I can link my 24 million. And therefore, can say goodwill. Our calculation gives rise to positive goodwill, which is 4 million. Now, before I come to non-controlling interest and consolidated retained earnings, what I'll do is to address the adjustments. And what are the adjustments that are required? The adjustment border on intercompany sale of goods between the parent and the subsidiary. And if you come back here, say, during the year, if I could enlarge it, during the year to 31st December 2015, which means between 1st of January 2015 to 31st December 2015, Pali, which is a parent, sold goods costing 10 million naira at a profit of 20% on cost to the subsidiary. Now, as at the reporting date, only 40% of these goods were sold to external customers, which means if we compare this scenario of the fact that one, the parent sold to the subsidiary at cost plus profit, and the subsidiary was only able to sell 40% of these goods to customers. Now, if you look at these four scenarios we have, which one does it belong to? And on that premise, we need to require elimination of unrealized profit or not. Now let's look at the four scenarios. Scenario A, B, C, and D. Let me minimize it. Okay, which of these four scenarios? If you look at it, it belongs to scenario D. Okay, scenario D is where it belongs. And in that case, it's going to trigger unrealized profits. Now to do that, what we need to do is to take it step by step. Now, parents, which in this case is Pali, sold goods to subsidiary, which in this case is Susie. Now, this transaction will be categorized for simplicity's sake as a downstream transaction. A downstream transaction is a transaction between the parents and the subsidiary, where the parent is the one that initiates a transaction or sells an item to the subsidiary. and the subsidiary becomes the buyer. Which means the same parent that is on top, as you can see here, will be the one looking downwards to do with the subsidiary, as you can see here, to conduct that transaction. Invariably, we'll consider that a downstream transaction. And you see the effect of that as we move on. Now, in that situation, what adjustment are we trying to trigger? We want to raise an adjustment for unrealized profits, URP, on intercompany sale of goods. Now, we ask ourselves the following question: what is the profit on sale of goods? In this case, profit on sale of goods can be obtained either by A, profit on sale of goods can be determined if you are not given the selling price or the revenue or the value to which profit has been loaded. You can determine it based on this information, where you have your markup and you multiply it by your cost. This one way. Another way, based on information where you don't have revenue or sales value, is where you are given margin, and you can determine, where you are given revenue but you are not given cost. You can determine it by, say, profit on sales sale of goods can equally be margin multiplied by sales value or selling price, as the case may be. But in an ideal situation where they give you your revenue and costs, you simply say sales value minus costs. Those are the three possible scenarios you can use to ascertain what is your profit on sale of goods. Okay. Now, in this question, what are we given? We're given the cost and we're given the profit on cost, which means in this question now, we have the following information. cost, which in this case, I'll put as $10 million. And we're given profits on costs, which is markup. When you express profit on cost is markup, and we're given markup of 20%. Therefore, which of what is above can we make use of? Can anybody answer that? Which of these three can we make use of based on this information provided?
It's A.
A, thank you. Therefore, I'll make use of this. Which means if that is the case, I can now say to get this, it will be I multiplied by I. Sorry, small I. And what is that? I multiplied by I, the product of 10 million and 20% will give me 2 million naira. Okay. Now look, answer this question. What if this is what was given to me? Supposing they gave me profits on sales value or profit on selling price of value, it means that what they gave me here is margin. Because when you expect profits as a ratio of sales value, what you have is margin. Therefore, what can I do if I'm found in this scenario? What should I do in this situation? Who can answer that? Who can answer that? What should I do where they gave me cost and they gave me margin instead of markup?
You work back to get the sales value.
How?
It's going to be 20% over 20% times 10 million all over 100%.
Where do I get 50%? Where's 50% coming from?
No, I said 20%.
Okay.
All over 120%.
Yeah, what principle are you using?
I don't understand, sir.
What principle is guiding you? I'm not saying you are wrong, but I'm saying what principle?
Is a subject of formula.
Some people are asking me, what do you mean by subject of formula? Okay, let's now also assume that they gave you not cost, but they gave you sales value or the worth of that transaction, but they gave you profit on cost here, which in this case, it is markup.
You're gonna compute down to 100%.
And what principle again is guiding that? You know, I'm not saying you are wrong, but the question is, anything you do that you can't define methodologically or as a process that another person cannot lay hands on independent of you and get the same results will be considered a fluke or will be considered a knowledge that is not transferable. And now, where am I driving at? Is to take us back to those days where we talk about markup and margin, the relationship between two of them. What's the relationship between two of them? Let's recall that one, markup is expressed as follows. It's expressed as ratio of profit over cost. Do we agree? Which is measured in percentages. Okay. Now, in that case, let's say this is equal to 25%, which means 25 over 100. And in that case, 25 over 100 is equal to 25%. Let me put it in percentages. Now, let's say markup. Sorry, margin. How is margin defined? Margin is defined in similar manner, but what changes is the base, sales value or selling price. Now, in that case, what has happened? Let's say that is ratio 20 over what? 100, and that is 20%. Now, what then is the relationship between markup and margin? What's the relationship between them? Now that will lead us to how to convert markup to margin. Now, if you recall what markup is, therefore, I can say this is simply as P over S over C. Which means if I say P over C, what am I saying? I'm saying let profit be P and let cost be what? Be C. Therefore, if that is 20%, I can tell you vividly, which is what we have here, I'm sorry, 25%. I can tell you vividly that converting to margin entails the following. My margin will now be this P over C is a markup. If you go by what we have here, but by the time I had another P to the denominator, what I have is C plus P. Recall that your selling price.
Hello, sorry, sir.
Yeah.
So sorry. Is there no way of computing together arrive at that C plus P? Because it's an assumption.
Where I'm coming. That's what
okay.
I'm trying to explain. That's what I'm giving you. Recall that selling price, which is S. How do you determine selling price of your product? Is first of all, you know your cost of the product, which is C. And you determine how much profit you want to make. If I buy something for 10 naira, I was okay, I must make 2 naira from this. When I now add the 2 naira to 10 naira, what do I get? I get how much I'll sell it for. And that is how we need to understand that S equals to C plus P. Which means in order to convert my denominator from cost, which is C, to S, I need to add profit to it. And that is what I'm trying to do. Invariably, what do I have? Invariably, what I have, in this case, is now P over S. Because C plus P is S. Do you agree? Now, in doing so, what then can I do here? What is my P here? My P is 20, sorry, 25. What is my, sorry, okay,
it's 20.
Okay.
Your P is 20, sir.
What is my S? My S will now be 100. I mean, plus what? 25. Does that make sense? Which means,
okay,
because I want to convert C plus P to S, which means by that conversion, what do I have now? By that conversion, what do I have? Let me copy and paste the same. By the conversion, I now have 25 over 125. Therefore, doing so, what percentage will it give me? It will be 25 over what? 125. And that is this 20% I'm saying here. This is 20%. Take note of this. And I can light it in yellow to take note of this relationship between selling price, cost price, and profits. Now, in similar vein.
So sorry, sir. So the principle now is a markup versus margin principle.
Yes, it's a principle of conversion.
Okay, principle of conversion. Okay.
Now, let me also now convert. How do I convert margin to markup? Now, let's come back here. What's my margin? My margin is profit over sales value, which is P over S. And we said it's 20 what? Percent, 20 over 100. Now, we'll come back here. and say, what is markup? My markup is P over C. But to get P over C, if I have P over S, is for me to deduct P from S. If you recall again, I'll call it since we are aware that selling price is this. Therefore, if I want to get C, C will not be equal to what? C, if I want to get cost, which is C, it will be C, capital C, will now be, if you collect like terms, you now take P to the other side. It will be S, which is selling what? Price. S minus what? Profit. Which is P. So then in this case, what will I do? I'll now say S minus P, which is this. In that case, what do I do? I'll say 20 over 100 minus 20. Do you agree? Well, that means 20, 100 minus 20. What is it? 80. And that gives me back my 25%. Do you get it now? Which means when you face with this situation, what you do is to use the relationship, the understanding of the relationship between margin and markup and between selling price, cost price, and profit to determine what's supposed to be. Okay, and that is the position I'm talking about. Okay, any question on that? And that is that. What that means that if you come back to what we have here, if you find yourself in this situation, what you do is that you can't apply margin on cost. Therefore, what you have to do to margin, convert margin to markup to get 25%. You now apply 25% on this. And if you have sales value, but they give you markup, you can't apply markup on sales value. Therefore, you convert markup to margin. And in that case, you use 20%. Okay, in that case, all things being what? Equal. Does that make sense to us now? Okay, take note of that. Now, let's come back here. All of these are not necessary because we are given our information on a platter of what? Of gold. And that's why here we are able to apply markup directly on cost, having determined that this is a formula relevant for us. Even though we have other two formulas, it depends on available information. Now, the next question is this. Can we say the 2 million profits on sale of goods above is unrealized? Can you say that? Yes or no? This 2 billion?
No.
Okay, why do you say no?
40% of the goods were sold to external customer as at the reporting date.
Mhm.
So that means that certain percentage of the 2 million naira means only 40% of the 2 million naira was realized before the reporting date.
If certain portion of it was realized before the reporting date, what portion is now unrealized?
60%.
Okay, thank you. Which means we cannot say that all of the profits are realized because a portion of the intercompany sales were unsold in the hand of a member of the group. Hence, we need to ascertain the portion of the profit on intercompany sale of goods that remain unrealized. Therefore, in this case, we need to determine that what portion is unrealized and what portion is what? Realized. Okay. Now, how do you do that? We'll now find what is the percentage realized. Okay, let me start with percentage on sold goods, which constitute inventory, and percentage sold goods, which constitutes sales. And this will be influenced by, what is realized from what is unrealized. Now let's look at the percentages. To make 100%, I'll put the one sold in green and the one unsold in red. Okay, while we have the total must sum up to 100%. Now, what was sold? We were told in the question that 40% of these goods were sold, which means 40% is realized, which means what is the percentage unsold and unrealized? It will be 100 minus 40, which is what? 60%. Another way the question might come is that instead of them giving you percentages, they can tell you that of the goods costing 10 million, as at the reporting date, only 4 million cost of those goods were sold to external customers. which means if in that case they gave us in value, let me assume they gave us in value, which means they gave us in value. It means the cost is 10 million. And what was sold, the cost of what was sold is 4 million. Therefore, it means it is 6 million. And if you now find percentage of 4 million as a ratio of 10 million, you get what? 40%. And if you find percentage of 6 million of that 10 million, you get 60%. And that is another way of doing it. Okay, that is that. Okay, I can grade this out. Okay, let me steal out of one of my lines. I don't need this for this information. I only provided it for knowledge sake. Okay. Okay. Now let's continue. Now, another thing you need to be wary of in the question is this. What if the examiner says, as at the reporting date, only 40% of these goods were included in the inventory of the subsidiary? What does that mean? What does that mean?
It means that only 40% of the goods that were not sold as at the reporting date.
Which means in that case, I rather come and say, this is 40, and the difference between 40 that is unsold and the total 100% goods will give me 60 that were sold. Which means it's the understanding of the information provided and based on your knowledge of the domain, which is a business, that will always give you a clue about what to do. Which means it's principle-based. Try to understand the principle rather than just the theory. Okay. Now, let us now go on. It then means that then we need to determine the unrealized profits as thus. How do you determine unrealized profits? If out of these 2 million, these 2 million emanated from the sales of 10 million, from the cost of 10 million. And we are now told that 40% of it, of the goods were sold, therefore the profit is realized. But 60% remain unsold, therefore the profit is unrealized. I can now say vividly that my unrealized profit on inventory, because it's unsold, which is URP, will equal the percentage unsold multiplied by the profit on sale. Therefore, percentage unsold, remember it's in red, and profit on sale, which is in green. I'll put that in green later. I'll put this one in blue. Okay. Therefore, what do? I can come back here and say, what I have here is now 40%, 60% from the information above there, multiplied by 2 million naira. And what would that give us? That would give me unrealized profit of 60% multiplied by the 2 million, which is 1.2 million is unrealized. Now, who made these profits? The profit was paid by the seller. And who is the seller in this case? The parent. Therefore, the profit of the parent as already contained in the retained earnings, which is 140 million here, has been overstated by 1.2 million naira. Why? Because the inventory of the subsidiary, this 45 million here, has been overstated by the profit of 1.2 loaded to it, given that it has not been sold to the third world parties. Therefore, what do we do in that case? We then need to carry out necessary what? Adjustments. Carry out what? Necessary what? Adjustments. Therefore, what do you do in this case? I'll come on to the accounting entry. Now, the profits of the parent have been overstated. Therefore, I'll remove it from the consolidated profit, which is the consolidated retained earnings of the parents. Because when profit has been overstated, the reserve will have been overstated. And the inventory value, which is an asset of the subsidiary overstated, I remove it before consolidating it, which means that within the group inventory, the angle of the subsidiary, I'm going to adjust for, I'll adjust for, I'm looking for this here. I'll adjust for the unrealized profits. Therefore, the unrealized profit in this case is 1.2 million. Okay. Now that is it. Now, which means I'll come here where I have non-controlling interest, and I'll come here and say adjustment for unrealized profits on inventory or on sale of what? Unsold goods. There's none. Why? Because NCI is not affected. Who made the profits was his parents, which means from the angle of the parents, sorry, okay, this is parent, NCI, sorry. Let me try and create that. This is the parent. Now, from the angle of the parent, we say we should remove 1.2 million from it. And that's 1.2 million. And we put everything to one decimal place or two, then put it to 2. Okay. Okay. I'll pick that. I use it to replicate here. So I'll pick this also to replicate here. As of this side, are not required. Okay. Now, let's now go back. Share of profits is 20% of 40 million. And that's 20% of 40 million. And this is 80% of 40 million. Now, what is the reserve of the parent on a standalone basis? 140 before adjustments. And therefore, this is what the adjustments has given to us. In doing so, we can proceed to consolidate. PPE, we have 110 plus 120. 110 plus 120 will give us 230. Goodwill, we have it to be 4, positive. Now we have to break this down the way it is here. Okay, therefore I have to shift. Let me shift this one upward once. Okay. My current assets. Now I'm breaking it down for the first time. Now what I need 2 more lines there. Let me shift this one downwards. 2 lines. Okay, it tells me to shift it from there. I can just shift this like this here. Therefore, I come here. The first item I have there is inventory. Inventories. I have 40 and 45. But remember, an adjustment is required to remove from the inventory of subsidiary out of this 45, 1.2. I'll asterisk it and put it in red because of the unrealized profit. Let me bolding it so that you know that this constitutes an adjustment. Okay, and in that case, it will be 40 plus 45 minus 1.2, which we have here. Next, we have trade receivables. We have 15 and 12. 15 and 12 will give me 27. And we have 5 and 7. 5 and 7. We have this. And all in all, what does that sum up to? 123. And 123 plus 234. Now this is in decimal. Let me pick this up so I can use it in decimal. Okay. Okay. Share capital, Pali alone is 80. Consolidated retained earnings is 170.80. Non-controlling interest is 32. Total equity is 282.5. Therefore, my current liability, I think, is broken down into, okay, let me just break it down myself, though it's not broken down, into trade payables. And I'll call these trade payables 50 and 24. And 24, give me 74. All in all, I have my balance sheet in agreement. Which means we've looked at a situation where we have unrealized profit on inventory when sales was made by the parent to the subsidiary, which we characterize as a downstream transaction. As opposed to that, we'll look at a question where all of the information remains the same, but the only twist is that rather than parents selling to the subsidiary, it was now the subsidiary that sold to the parents. But before then, any questions? Any question before then? Okay, if there's no question, now let's switch to a situation where it was the parents, sorry, the subsidiary that sold. Okay, can somebody read this starting from upstream transaction and you read it to the end of this balance sheet? Over to you. Madam Janet, are you there? Can you read?
I'll read. Upstream transactions. This involves the sales of goods by the investee subsidiary to the investor parents. Since the profit is recognized by the subsidiary upon sales to the parent, the unrealized profit should be adjusted partly against the consolidated retained earnings with respect to those attributable to the parent and partly against the non-controlling interest with respect to those attributable to the parent and where the subsidiary is partly owned by the parent company. Accounting treatment and entries. Remove the whole profit loading and charge the non-controlling interest with their proportion preferred method. Debit consolidated retained earnings with the parent share of unrealizable profit. Debit non-controlling interest with NCS share of unrealized profit, and credit group inventory statement of financial position with the total unrealizable profit. Pali illustration 2. Pali PLC acquired 160 million naira of the shares of Suzy PLC when the reserve were 20 million. During the year to 31st December 2015, Suzy PLC sold goods costing 10 million by profit of 20% on the cost to Pali PLC. As at the reporting date, only 14% of the goods were sold to external customers by Pali. In the same period, the statement of financial position of dual company Hello. Hello, can you hear me?
Okay, thank you for the question. Now, you see that the same question, but in this case, it was the subsidiary that made that sales to the parents. How would that affect our situation? And that's what we want to look at. Let me copy the question and I paste it on. Okay. I can duplicate these templates. And we won't repeat all of the process again because we've already linked everything. Now, since you can see my screen, what we only change is the principle of downstream and upstream. In this case, since reverse is the case, it was the subsidiary that sold to the parent. It means somebody beneath you is looking up on you to transact with you. We consider that as an upstream transaction. Now, in an upstream transaction, what we are simply saying is that this profit of 2 million was made by the seller, which in this case, the seller is the parent, sorry, is the subsidiary. Now, the seller has overstated his profit by 1.2, since we are able to realize that 1.2 million of it is unrealized. Now, this 1.2 million is embedded in this 60 million of the subsidiary retained earnings. What that means that invariably, what then we need to do is that we need to remove it, so that if we remove it from here, what will be left is about 58.8. And if what is left is 58.8, for example, 60 minus 1.2 million unrealized profits. If I go by that, which means I'll say 60 minus 1.2 million. What is less is 58, which means my post-acquisition will have been 38.8. Now, doing so will affect what will go as a distribution to NCI and to the parent. Can you see it here? All because it's no longer 20% of 40 million, but it's 20% of 38.8 million. Okay, what that means that invariably, this will no longer be required because I've adjusted directly this in this. And you can see what my balance sheet looks like. Now, let me compare this balance sheet with what I've done before so that I can see the beauty at a glance. This was our balance sheet before when it was a parent. Now, let me put aside the balance sheet when it was now a subsidiary. Now, you can see the distribution here. Nothing affects the asset side, but you see that the consolidated retained earnings was 170, but now 171.04. NCI before was 32, but now 31.76. What has happened? What has happened invariably is that unlike when the parent was the one that absorbed the whole effect of unrealized profits, in this other case, it is both the parent and the NCI. Why? Because the subsidiary was the one that has unrealized profits, and the adjustment for that unrealized profit to lower the profit of the subsidiary will affect the shareholders, who eventually are the parent and the NCI. And this was what necessitated the adjustment here, where we said that for opt-in transaction, in this case, what you do invariably is that the effect of removing the profit will be borne by who? By the parent with his own share, and by who? By NCI with his own share. Okay, therefore, I'll call this method here, where we got that information from, as A. Which means if I don't want to do it by adjusting for this 60 here, I can equally do it by way of sharing, still using 60, but later on pass an adjustment where the parents and the NCI will share the burden. Okay, now remember, in this case, it was a subsidiary because the subsidiary was the seller. And in this case, for the inventory is the parents, because the parent is this. Therefore, which means I can move this adjustment here so that you know that the inventory affected is this. Okay, which still doesn't change anything. But I'm just trying to do it in such a way that position it that this is an adjustment against the parents inventory, unlike this one, there is an adjustment against the subsidiary inventory. Okay. Therefore, if that is the case, let me duplicate it and show you how I prefer it in such a way that explains it better for you. Now remember, this was the position we had before, 58.8 after adjustments, and therefore I said this will no longer be required. Okay, which is what we've done in this manner. Let me just put it up. Okay, let me look at the B. The B aspect is for me to pass the adjustments reflecting what we have agreed to say, okay, there are two debits. One is consolidated retained earnings, which speaks to the percentage of the parent, which in this case, the percentage of the parent is 80%. And the second one speaks to non-controlling interest, which speaks to 20%. Now, 80% is how much? 80% is a parent of 120 million, which means any loss on the subsidiary, the parent bears in it, and the NC also bears in it 20%. Likewise, any profits. And the sum of these two is what make up 1.2 million. Can you see it down here? And that is this 1.2 million, that is a credit to the inventory of the parent. Okay, in that light, I take this out. And this is my new position of the adjustments. Okay, now if that is the case, and that means those adjustments I want to replicate here. And I'll say, instead of me adjusting with 38, which is what is here before, it's now 60 because I decided not to adjust for the unrealized profits there. Rather, I'm making the adjustment one by one, which means I said I should share the loss to NCI or the reverser of that unrealized profit to the NCI. And what portion did I share is 0.24. I remove it so that at the end of the day, if you check these profits, let me pick this. At the end of the day, what I'm trying to do is, if you check here, after sharing 8 out of 40 million, taking 8 out of 40 million, and you now remove 0.24, what is left? What is left there is 8 plus negative 0.24 will give you 7.76. If you are familiar with this 7.76, if you come to the A, you'll find it here. 7.76, because we did it directly here. Likewise, if you repeat the same thing with the subsidiary, which means you are deducting 0.96 from this. And if you do the same thing, yeah, what you have is 31.04. And where can you see 31.04? Can you see it here? And that's what we're trying to say, that any of the approaches you adopt, you'll see come to the same conclusion. And that's what we're trying to explain, which means in this case, when it's an upstream transaction, you must be rest assured that you need to adjust it against both the parents and the NCI. Okay, but if it's a downstream transaction, the adjustments only affects the parent. Any question on that? Now you can see what we've done. Therefore, A and B is the same thing, only that we are looking at different approach to, should I adjust it from here? Or should I, in this case, I adjusted it from here, which I can put in this dark color for you to know that I made an adjustment here. Okay. Or I decide not to make the adjustment here, but rather I make the adjustment individually from this perspective here. But all will still provide me the same answer, which means you need to ask yourself and follow it methodologically. Who is selling to? The entity that sells has recognized a profit, and you are not claiming that that profit is unrealized. Therefore, is that entity that will burn it? If it's the parent burn it. If it's the subsidiary burn it. But again, when subsidiary burn it, it affects its ultimate shareholders, who is now the parent and NCI. That's why, regardless of the instances, parent will be affected on both ways. But in one way, parent is affected in full. In the other way, since it's for subsidiary that is affected first, the parent will be affected to the extent of the stake or interest it has in the subsidiary, while NCI will take its own body out of it. And that is what we have done. Any question? Any question? Let me sum this up. And let me sum this up. Therefore, what do you have here? That's 1.2. And that's the position we have here. Okay. Is there any question? Okay. Therefore, we'll move to other transactions, which is between the parent and subsidiary, where there's transfer of tangible assets. Imagine the parent is vacating his former head office because it's now too small and trying to sell it to the subsidiary, since it's now moving to a bigger one. And he will have sold at a situation where the selling price or the transfer price is higher than the carried amount, thereby necessitating profit on disposal of an asset. Within the group, whenever any member of the group sells to the other an asset at a profit, it constitutes unrealized disposal profit in the group. What then do we do in that instance? We identify what is the profit upon transfer, and we eliminate. But it doesn't stop there. As I've said earlier, it also has impact on depreciation that is charged by the buyer subsequently. And what is the implication? The buyer, regardless of what you have done at group level of elimination, the buyer paid for it at a price above the carried amount, and that is the price to which is reflected in his book on a year-to-year basis, which he has subject to depreciation. Which means invariably the buyer will have been depreciating the asset in his book, at a higher value. Whereas from the group perspective, we have been depreciating the asset in his book at a lower value. But it doesn't stop there. As I've said earlier, it also has impact on depreciation that is charged by the buyer subsequently. And what is the implication? The buyer, regardless of what you have done at group level of elimination, the buyer paid for it at a price above the carried amount, and that is the price to which is reflected in his book on a year-to-year basis, which he has subject to depreciation. Which means invariably the buyer will have been depreciating the asset in his book at a higher value. Whereas from the group perspective, we have eliminated the profit on paper, and therefore on paper too, the depreciation is supposed to be the same. But rather, in reality, the depreciation is higher in the hands of the buyer. What then do we do as a group accountant is to continuously track the difference between the depreciation by the buyer, which is higher, and the actual depreciation precedent to disposal within the group, which is lower. That constitutes what we call excess depreciation, which is, or what some people will call over depreciation. And that will have suppressed the profit of the buyer so much that we need to reverse or adjust for. And that also will have effect on the carrying amount of the property, because higher depreciation charge on the carrying amount will be faster to reduce the carrying amount than what is supposed to be. And therefore, we'll look at how do we treat this situation, also coming from the perspective of whether it's a parent that is making that sales or transfer, or it is a subsidiary that is selling off its asset to the parent in that regard, which means the principle of downstream transaction and upstream transaction respectively will equally impact and will be taken into consideration. Okay. Okay, in continuation, we'll more or less look at some aspects of our discussion. I want you to read one or two things, and from there we'll elaborate much more on it. And we'll look at illustration to depict our understanding of what we have been discussing so far. Okay, over to you, Mr. Anthony. Can you make an expression of what is displayed? And I'll take it off from there. Thank you. Mr. Anthony, are you there?
Sorry. Sorry, I didn't mute. Okay. I didn't unmute my mic, yeah.
Okay, you can start now. Thank you.
All right. Intra-group transfer / sales of property, plant, and equipment, including similar assets. It is a common practice for intra-group transfer or sales of property, plant, and equipment, PPE, investment properties, intangible assets, etc. There is no problem upon consolidation if the non-current assets have been transferred at current values. Otherwise, it poses a challenge upon consolidation to eliminate any profit or loss resulting from differences between the carrying values and transferred prices. The transaction is similar to that of the sales of goods only, that there may be a need for additional adjustment resulting from the transfer of non-current assets at a value different from its carrying value, which will ultimately result in over or under depreciation on the assets. Provided the asset is depreciable, the adjustment may require the reversal of over depreciation, excess depreciation, where the transfer price is greater than the carrying amount, and charging of additional depreciation with respect to under depreciation shortfall. Where the transfer price is less than the carrying amount, the adjustment requiring additional depreciation with respect to transfer within the group below carrying amount may not be necessary if there is an evidence of possible impairment of the assets transferred. This arose from the fact that prior to the transfer, there may be an impairment trigger that justified the reduction of the initial carrying amount of the asset to its recoverable amount. In such case, no adjustment will be required for the reversal of loss or transfer, since it is considered an impairment loss, which is consistent with the requirement of IS 36 and charge of additional depreciation. We could further classify the transaction between the parent and the subsidiary as either of a downstream, i.e. down the stream, or upstream, i.e. up the stream transactions. Downstream transactions are those transactions emanating from the parent to the subsidiary, e.g. plant transferred to the subsidiary by the parent. Upstream transactions are those transactions emanating from the subsidiary to the parent, i.e. e.g. plant transferred to the parent by the subsidiary. Please scroll up, sir.
Thank you very much. That is where I want you to more or less have a discussion. Now, let's start from a situation which is a normal situation where you transfer at above the kind amount, and that gives rise to profit on disposal of asset, which we are now considering to be unrealized. Therefore, in that manner, what will happen in this situation? Now, to do that, we will more or less look at a question that will give us room towards doing that. And on that basis, I want you to read this illustration 3. Can you start from illustration 3, please? Mr. Anthony, can you unmute?
Pali PLC acquired 160 million of the shares of Suzy PLC since the incorporation of that company. Pali PLC transferred plants to Suzy PLC for 40 million naira and has a carrying value of 36 million naira as at the transfer date, 1st January 2014. The group has a uniform depreciation method for the same class of assets, which is a straight line method. As at the transfer date, the remaining useful life of the plant is the remaining useful plant. The remaining useful whatever of the plant is 10 years. The statement of financial position of the dual companies is as at 31st December 2015. We are as follows. Statement of financial position as at 31st December 2012. Assets. Non-current assets. Property, plant, and equipment. 110 million. In Pali, Suzy, 120 million. Investment in Suzy PLC, 100 million. Current assets, inventories, 40 million in Pali, 45 million in Suzy. Current accounts receivable, 15 million in Pali, 12 million in Suzy. Bank, 5 million in Pali, 7 million in Suzy. Total asset, 270 million in Pali and 184 million in Suzy. Equities and liability. Equity, ordinary shares in 15 naira per share, 80 million Pali and 100 million Suzy. Retained earnings, 140 Pali, 60 million Suzy. Current liabilities, total equity and liabilities, 270 million in Pali and 184 million in Suzy.
Okay, thank you very much, sir. Now, in this case, we'll now more or less resort to our spreadsheet and try to solve the problem. Okay, given that the information remains the same with respect to determine our structure, now our structure in this case, remain the same. And we've more or less determined that to be 80%, which gave us this condition we have here. Okay, in doing so, what then is left for us to do is that all things being equal, we go back to our information here and see whether there are things that have changed. Now, the reserve as at the point of acquisition. Now, the information here shows that Pali acquired 160 million shares of Suzy since incorporation of that company. Now, if you have to go by that, let's put up a new chart. Okay, a new chart that means that the group structure has not changed other than the date. Therefore, I can more or less copy this and modify the dates. Let me copy this minutes. Now, the only thing that I've changed is that this date was since incorporation. It's not some time ago, but rather since incorporation. Therefore, I can cut it off and copy it on my spreadsheet. And let's go back to our spreadsheet. I'll replace it. And that plays a role here. Who can tell me what is our pre-acquisition reserve? If our reserve in the balance sheet was 60, what would be our pre-acquisition reserve? What's our pre-acquisition reserve from this information here? What's our pre-acquisition reserve? Who can tell me? I'll wait your answers. What's our pre-acquisition reserve? I can't hear anybody.
None.
Why is it none?
Since they've acquired it since incorporation of the company. So that means that they've, at the beginning, when they started, I don't think there is anything like profit there. My sense.
You know that there's nothing at the inception of the company.
Well, they've not started business. If it is as incorporation, it's after you incorporate a business, you now start selling, and then you now.
Which means that, oh, I'm just trying to tell you that you don't think, you know that.
I know, okay.
It's set up with profit at the beginning now, because profit is the result of your activity from the business, which means if, as at the time the acquisition takes place, the company is just being incorporated, and that means that there's no profit ab initio, which means you know that there's no profit, which is zero. Now, since it's zero, it means the entire profit is post-acquisition, and that's what I'm trying to emphasize. Which means that in this case, we'll come back. What is our investment in Suzy? 100? It remains as 100. Now, we'll come back to NCI. What is the share capital of Suzy? 100? It remains at 100. But what's the pre-acquisition? Is 0, because we have said here that it is 0. Okay. Or because from here, the pre-acquisition is 0, which we can easily link with this. Now remember, how do you get 80% is what we've done here, and it has become a recurring decimal. Which means here, we can now come back to say NCI is 20% of 100 million. Okay? Therefore, I come here to change this 100 million, which already at the model answer, he has given us that, which is 20% of 100 million. Now, NCI is 20 million. Okay, and by the time we do that, it will give us goodwill of 20 million. Now, let's now go back to what the issue lies here. Therefore, there is sale of assets, not goods in this case. Sale of asset, and what was the asset? Sale of plants. And the sale was conducted by the parent to the subsidiary, which means we need to determine or realize profit on intercompany sale of assets or transfer of plants. Now, all of this will not apply because we are not dealing with sale of goods. Therefore, I'm going to take all of this off. Or for simplicity's sake, let me just cut it and paste it here and delete all of this. No, I know this. Okay. Okay, we'll come back to those ones. Now, to do that, unrealized profit in this case is for us to compare the transfer price of the plants with the carrying amount of the plants, all at point of disposal. Which means we are told that the plant was sold for 40 million, whereas the carrying amount of it at the point of sale was 36 million. In that case, what is our profit on disposal? Our profit on disposal which is only unrealized, is how much? There's a difference between these two. 40 and 30, negative 36, which is 4 million. Now, this 4 million is termed unrealized. Who made the profit? The profit was made by the seller. Who is the seller? Is a parent. Therefore, if we are to reverse the profit, we'll reverse it against the seller. And therefore, that will trigger the fact that since the profit of 4 million is contained in this 60 million, in this 140 million of the parent, therefore, this 140 is overstated reserve by how much? 4 million. What then do we do? We'll reverse 4 million of it from the parents. And also, the property, plant, and equipment of the subsidiary is overstated by this 4 million because it's carrying it at 40 million as opposed to 36 million. As I've said earlier, why are we doing all of this is because transaction within the group should not create or reduce the value since you can't make profit out of yourself. Okay, anything profit or anything loss should be ascribed to your dealing with the third parties. And in this case, parent and subsidiary are considered to be the same and one. And therefore, such is not considered to have been done with third party. And that is what necessitated all this adjustment. Now, 4 million is what we're going to adjust against the group property, plant, and equipment. Okay. Now, doing that is what we're going to do here, which is now unrealized profit on sale or transfer of plants, which in this case is what? An asset. NCI is not affected because the profit was made by the parent, which we are now retrieving, and NCI is not party to it. That's why it is 0. But the parent, we are taking out 4 million, which is what we've done here. Okay. Now, all things being equal, what is the share of profits? This is 60 million, which we are going to share in ratio 80-20. Therefore, I come here, I'm sharing 60 million to the NCI, which is a 12. As you can see it from this link, 20% of 60. And similarly, the parent will take 80 of 60, which is 48, as you can see here. 80% of 60, 48. Now, all things being equal, this 140 million we have here for the parent is what we have brought down here, which we are now adjusting 4 million from. Invariably, we have 32 as NCI as at the reporting date and 184 as consolidated retained earnings as at the reporting date. All things being equal, we can proceed to consolidate. Now, the adjustment here is against subsidiaries PPE. And what is the amount? 4 million. We need to reduce it because it's overstated. Therefore, I'll come here. Okay. But this adjustment is not total. And why? The reason being that I've not yet considered that we are not at the point when the transfer was made. Transfer was made on 1st of January 2014, which means between 2014 and 2015, which is a 2-year period, the subsidiary will have been depreciating the assets on the basis of value of 40 million over 2 years. Now, remember, at the point of transfer, we are told that the remaining useful life of the asset is 10 years, which means in that case, given that it's a straight line method, the assets will be depreciated at 4 million naira per year since there's no residual value. Whereas, if you are to have transferred at the kind amount, since it's intergroup, from an accounting perspective, it will have been 36 million, and which means it's 3.6 million over a period of 10 years. Now, this gives rise to higher depreciation being charged to the difference of 400,000 per year. And now, for the 2-year period that has passed, 2014 and 2015, that will have summed up to about 800,000, which means the profits have been profit of the subsidiary. And now the subsidiary is the one charging the depreciation. This profit of subsidiary of 60 million will have been more or less suppressed, which means it's understated. It's understated to the point of you charging more depreciation than is required from the group perspective, which then means that another adjustment that will be required in this case is adjustment for excess depreciation. Adjustments for excess depreciation on intercompany transfer of flats. Now, how do we do this? I'll consider the depreciation charge based on transfer price. I'll compare it with depreciation charge based on carrying amount. Now let's start with depreciation charge based on transfer price. If you recall, charging depreciation on a straight line basis is first determine the depreciable amount, which is the cost minus scrap value, and you divide it by the number of years. In this case, it is the difference between the 40 million, which when you divide it by 10 years, it will give you 4 million per year. And times how many years? 2 years has passed since the transfer took effect, which means it will be 8 million naira. Therefore, the 8 million is what was recognized in the books, as opposed to 7.2 million, which you are going to see. 40 million divided by 10 years multiplied by 2 years will give us, sorry, one person. 40 million divided by 10 years multiplied by 2 years will give us 8 million. And whereas if it's on carrying amount, it will have been 36 million divided by 10 will give me 3.6 million per year. And for 2-year period, it will give me 7.2. The 36 divided by 10 times 2 years will give me 7.2. Now, what is the difference between 8 million and 7.2? Which is the difference between what was charged and what ought to have been charged. It means we have overcharged this like this, which means this is what I will call excess depreciation, or what some people will call over depreciation charges over a 2-year period. Now, what would this have done is that the profit of the subsidiary year has been understated. Therefore, I need to gross it up. Therefore, let me copy what I did here. Which means I need to make an adjustment to increase it. I will increase it by 0.8. And what is that 0.8? Is depreciation adjustment. Depreciation adjustments. Okay, which means I'll say 60 plus the 0.8. Why? Because if you go by the accounting entry, which I'll do here, the credits for excess depreciation should go to the subsidiary. In order to restate his profit to what it's supposed to be, given that he has charged a lower depreciation amount. And the debit is to restate back the PPE of the subsidiary, because once you charge depreciation in excess, it suppresses the kind amount of your assets. And therefore, this is what we've done. And which means what I've done here is to more or less take care of that position. And that's already accounted for here, which means invariably that has been taken care of here, which means this is 60.8. As you can see here, that this is 20% of 60.8. And likewise here is 80% of 60.8, which is already taken care of here. That's 80% of 60.8. Okay, which means in this case, let me duplicate it before coming back. Which means in this case, these adjustments for the adjustment for depreciation here, because it has been taken care of here. Later on, you take note of what I'm doing there. Okay. Now, let's see the effects on our account. The effect on our account is one, by one entry, we say we should remove 4 million from the assets because it's overstated. And in the other breath, we say we should add 0.8 million because it's understated. Now, what is the net effect of that? Is that what is now left in the books of the subsidiary after adjustment is 120 minus 4 plus 8. And we'll consolidate that with the parent of 110, which means I'll come and say 110 plus 120 minus 4 million, which we have here. Okay, and plus 0.8. And that gives me 226.8. My goodwill, all things being equal, is 20. My PP inventory is 40 and 45. My receivable is 15 and 12. My bank is 5 and 7. And this consolidated to 370.8 million of naira for total assets. My ordinary share capital is 80. My consolidated retained earnings is 184.64. My NCI is 32.16. That gives me my total equity of 296.8. 0.8. And what is my payable? 50 and 24. And that is my position. And this is how my balance sheet looks like, having carried out these adjustments. Now, in similar vein, I can further show you the approach I can equally use in doing this, which is still going to give you the same results. And what is it? Is that rather than make the adjustment here at the point of splitting, I rather leave it at what it is, 60, and come back to individually pass the adjustments and look at what I'll do. Which means here, I will go back and reflect what's supposed to be, which means no adjustment is required. And that means I take off these adjustments there and I assume I've carried out my operation here, and I share this 60, which is 12 and 48. I return this to 60, will give me 12 and 48 in the ratio, the NCI and the parent share profit of 20 and 80%. Now, I will now be forced to carry out an adjustment which I'll infuse here, which means I'll come here to carry out an adjustment where I need to recognize the burden of adjusting for excess depreciation as it affects the subsidiary in the parent and NCI. Excess depreciation adjustments on transferred plants. Okay, and what is that? Instead of me carrying out the adjustment there, I'll do it here, since the subsidiary is to be affected. Since the subsidiary profits or losses to be affected, and what I perceived excess what? Depreciation adjustment. Therefore, rather than do that here, what I'll do is that the effect will be on the parents and the NCI. Therefore, I'll come here and pick this. The credits will affect the parent 80% based on this percentage, and NCI 20% based on this percentage here. Now, invariably, what will I do? Now, 800,000, which is 0.8 million, affects the group plans. Therefore, 80% of that amount is the burden, or is the effect of it that affect the NCI and the parents, and 20% of it affects the NCI. In this vein, what do we have? Is that the effect of that NCI, we have a benefit which increases its profits because we are told to credit NCI by 0.6, and the parent will have it increase its profits by 0.64. And if you go back again to similar thing I did here for you, you find out that once you sum up this, let me do it here. Can we move this one down? Just for my explanation. Which means when you sum up this, you have 12.16. Where can you see 12.16? You can see it here, 12.16. Similarly, when you do the same thing here, you have 48.64. Where can you see 48.64? You can see it here, which means it's just a matter of approach. But what you get will still remain what? The same. 32.16. And 184.64. Which means if you go by that, and I replicate what I have here, you should be able to produce the same results. Okay. I link this appropriately. 184.64. And NCI link it appropriately. 32.16. You find out that your position remains the same. And that is that, which means if you look at this balance sheet and pair them together, you see the consequence of treating it, and it doesn't change the perspective. That's why what matters is the understanding of the principle. Now you can see the position remains the same, regardless of the fact that you have two ways of making that adjustment. Okay, any question on that? But don't forget, what we have still done in this case is considering the fact that it was a parent that sold. Now, what would be the position if it were to be the subsidiary that sold? Therefore, that'll take us to another illustration. Okay. Now let's read that illustration. Now let's look at the illustration. Who will read for us? Who will read first? Madam Janet, can you read first?
Okay, sir. From the illustration, sir.
Illustration 4, yeah.
Okay, sir. Hardy PLC acquired 160 million of the shares of Suzy PLC. Since the incorporation of that company, Suzy PLC transferred plans to Hardy PLC for 40 million naira and has a carrying value of 36 million as at the transfer date 1st of January 2014. The group has a uniform depreciation method for the same class of assets, which is a straight line method. As at the transfer date, the remaining useful life of the plant is 10 years. The statement of financial position of the dual companies as at 31st December 2015 were as follows. Statement of financial position as at 31st December 2015, Pali PLC, Suzy PLC, all in millions. Asset, non-current assets, property, plant, and equipment, 110 for Pali, 120 for Suzy. Investment in Suzy PLC, 100. Current assets, inventory, 40 for Pali, 45 for Suzy. Accounts receivables, 15 for Pali, 12 for Suzy. Bank, 5 million for Pali, 7 million for Suzy. Total assets, 271.84. Equities and liabilities. Equity, ordinary shares, 0.50 naira, that's 50 kobo per share. For Pali, 80, for Suzy, 100. Retained earnings for Pali PLC, 150, Suzy PLC, 60. Current liabilities for Pali, 50, for Suzy, 24. We have a total equity and liabilities of 270 for Pali PLC, 184 for Suzy PLC. So can you help me?
Okay, that is all. Thank you. Now, let's go back to our spreadsheets. Now, I've duplicated the spreadsheets and I've copied the question. Now, in this case, all information remains the same, except for the fact that here, we are now saying that subsidiary sold to the parents. Okay, but all information remains the same. Now, in that case, who made profit is the subsidiary. And that means that it's the subsidiary's profit that has been overstated. This 60 million here included this 4 million, which has been overstated. Therefore, what do? We'll come here to reduce the subsidiary's profit. By 4 million. And whose assets has been overstated is the asset of the parents, because it's the parent that purchased that asset, which is not included in this one term. Therefore, though they all relate to the group, but we need to emphasize that is that of the parents. Now, in that case, that means that I can adjust the subsidiary's profit away from 60 by adjusting it by 4 million for the unrealized profits, which means the unrealized profit has overstated it. My adjustment then must be negative in order to remove it. Therefore, I'll say -4, which means if I do that, it will be 60 minus 4 million. And that gives me 56 million. This 56, after removing pre-acquisition, which is 0, gave me 56, which invariably will affect our sharing formula here. because this is 20% of 56. Similarly, 80% of 56. And that's why when you check this, you can see how it flows. 20% of 56 and 80% of 56. Now that is the first entry. Now the second entry depicts that who is depreciating the assets is a buyer. And who is the buyer is a parent, which means the parent has overcharged his profit with depreciation in excess of 800,000. If you remember this 800,000, and therefore this profit has been understated by 800,000, which have to be reversed. And in that case, we come back here, the parent's profit is what was affected by the over depreciation. Okay. And in that situation, is the parent's profits that we need to adjust for. Okay. And in that case, the parent's profit is also what you can know as what flows into consolidated retained what earnings, which means it still flows into consolidated retained earnings. Period. Okay. Therefore, in this case, what then do we do? We'll come then to the parent and say, this 140 has been understated by 800. And the assets or plan that's affected is that of the parent because it's the parent that is carrying the asset now in his books. Okay. Therefore, what do we do? We'll come back here to deal with excess depreciation, which has nothing to do with the subsidiary. Okay. Excess what? Depreciation. Let me come here and say adjustments. That's what I was looking for. Adjustment for excess depreciation. It has no effect on this NCI, but it has effects on the parent. And therefore, I have to add back 0.8. And doing so, give me what I have on the screen. Now, what is the effect? The effect then is this adjustment here is from the perspective of the period. I shift it forward. Before recognizing to consolidate that of the subsidiary, which means this whole adjustment is from the perspective of the period here, which means 110 minus 4 plus 0.8. I can even link it minus 4. Where's the 4? Yeah. 110 minus 4 plus 0.8 plus 120. That's giving the same thing. My good will remain the same. And I think every other information here remains the same. Now the share capital remains the same, but my consolidated reserve is now 185.60, flowing from this adjustment. My NCI is 31.2, flowing from this adjustment, which requires none here. And likewise, my trade payable is 5024. And that's the position we have here. Now, in this case, what have we done is that the unrealized profit is that of the subsidiary, and we adjusted for it directly. But we can also show the option where we can adjust for it not directly, which I'm going to show you. Whereas the parent aspect of the adjustment affects the parent as it is. Okay, and NCI is not affected in that situation. Now, let me duplicate this. And let's look at the perspective from where that adjustment or unrealized profits on the subsidiary is done outside this place, which means in this case, I decide not to do the adjustment there. And I state it back. And I state it back to what is supposed to be, which is 60. Doing so requires me then to say that the adjustment I'm to make now will simply be making it directly as it affects subsidiary to its shareholders, which are the parents and the non-controlling what? Interests. Therefore, in that case, what will I do? Let me shift this down. Okay, let me shift this up. Okay. It's going to affect both the parent and the NCI. It means, let me copy this. In that case, what do I have? The subsidiary. Sorry. Okay. I take it up. Yeah. The subsidiary profit is affected. Likewise, the parent the parent PPE is affected. But the subsidiary's profit will have effect on the parent and on NCI, the ratio, the share profit or loss. Therefore, I take 80% of that adjustment as it affects the parent, which is 4 million. And I take 20% that it affects the NCI of that 4 million. All of this constitutes the 4 million when you sum it together. And remember, the 4 million is a reduction in the value of the PP because it is overstated. Therefore, what do I do? Is to effect these adjustments. Doing so means I'll come here as part of the adjustment to say let me increase the line here. And likewise here. And say adjustment for unrealized profits. Yeah, we are told to reduce 3.2 from the parent, sorry, NCI, 0.8 from the NCI. And we have to reduce 3.2 from the parent. And therefore, what do we have in this case? I sum it up, and I have this. I sum it up, and I have this. Okay. Now, if you go back here, what do we have? I can copy and now adjust it appropriately. Now the consolidated reserve here is now 185.6. And my NCI is now 31.21. I remember this is no longer 56, but 60. Why? Because we are not adjusting directly in the books. And that's why when you check this, the 12 is a product of 20 and 60. Why? The 48 is a product of 80% and 60. Now, similarly to what we've done here, I can sum this up and see the product of it. It's 11.2. Where do we see 11.2? If you remember, it is here. Also, I can do the same thing here. Which is 44.8. Where do I see 44.8? Is here, if I've done it directly. Okay, in that light, we have the same position. And when you check your balance sheets, if I can display it side by side, let me copy this and try to display it side by side here. You find out that we produce the same results. I can see here. Okay, there's something I need to first. I think we didn't link it well. Okay, can you see we didn't link this well? This is -4 plus 0.8. Okay, yeah, -4 not is equals to. And that is 226. I can see our result here now. Let me now copy it. which I can put side by side. Two to 6.8, 226.8, 2020. Everything under assets remain the same, except for here also, we can see that it's the same thing, which means we produce similar results regardless of the approach, which means there's no exception in this case. Now, that is the position as it is, which means be it upstream or downstream transactions, which means be it the parent selling to the subsidiary or subsidiary selling, what matter is for you to analyze who is the buyer, who is the seller, and two, who is affected by the unrealized profit, and who is affected by the adjustment relating to excess depreciation. It's that route that you follow at every point in time to determine how relevant you make your adjustments, rather than trying to cram what you need to do at any point in time. Which means regardless of how the problem is coined or framed, what matters is your own understanding of the principle and application of the principle to practice and use it to solve problems at every point in time. Any question? Any question? I believe you can hear me since. Hello?
No question for me, sir.
I believe you guys have been hearing me since.
Yeah, I'm with you. I'm following you.
Any other person?
Yeah, I'm with you, sir.
I'm with you, sir. Only
And I
that.
believe I'm audible since.
Sir?
I believe you guys hear me all through from the beginning to where we are now.
Yes.
Yes, yes.
Okay. Thank you. Any question?
I have question, but I think if I sit down with it, I will understand better. I just have a little challenge with the upstream transaction because the way we are doing the profit and everything, but I believe when I sit down and look at it very well, I'll get it. So I think I don't need more questions.
Okay. Any other question? Hello? Any other question?
Not from my side.
Okay, thank you very much. Now let's look further on other adjustments. And the adjustments we are going to look at now borders on intercompany balances. Okay, we'll look at intercompany balances. What constitutes intercompany balance and how do you make adjustment for such? Now, remember that we have been talking of sale of goods, sale of assets, and we presume before now that payment has been made before the reporting date, which means nobody's owing the other. But the reality is that not all payments will have been made in all respects. And therefore, one party will have payable, the other party will have receivable. Which then means that upon consolidation, we can't go ahead to consolidate when, on one hand, you claim you have a receivable from yourself, which is your subsidiary, and on the other hand, you claim there's a payable to yourself from the perspective of the parent. Which then means that you are double counting. And that will not necessarily reflect you as an economic unit. And to reflect you as an economic unit, we then need to eliminate common balances between you, the parent, and your subsidiary. Which that means that invariably, what constitutes receivable to you is a receivable from third party. And what constitutes payable to you is payable to other parties. Do you get what I'm saying? Do you get what I'm saying?
Yes, sir.
Yes, sir.
Okay, thank you very much. Now, in that perspective then, we'll look at for situation where we need to identify where there are these intercompany balances and how we'll go ahead or proceed to eliminating them. Now, I want somebody to volunteer with no noise background to take us through this expression before I take it further. I'm waiting.
Okay, intergroup current account. There are situations where the parent and subsidiary maintain current accounts. Intercompany receivables and payables. For tracking the intercompany balances and remittance of funds made on transaction between the dual parent and subsidiary. It is always expected that since the current account maintained by the parent and subsidiary accommodates the remittance of funds between them, then the balances should agree at all times as the accounts minor each other. If the current accounts do not agree, it means there may be some element of accounting error that will be corrected or some transaction considered to be in transit, such as cash in transit and goods in transit. Prior to consolidation, the balances are required to be reconciled and necessary adjustments should be effected before consolidation. Upon consolidation, it is a requirement that intercompany balances should be cancelled out. This is to ensure that the economy and financial position, performance and cash flow of the group as a single economic entity are reflected in the consolidated financial statements. Where adjustment for cash in transit and or goods in transit are required and for the purpose of reconciliation of intercompany balance, that is current account, the following accounting entry is required. Accounting entry for recognition of cash inventory in transit, debit group cash and bank inventory, credit current account, either of the current account as they ultimately will cancel out with the amount of cash and or goods in transit. We consider an illustration where the current account maintained by dual company agree as at the reporting date as depleted below. Pali PLC acquired 160 million shares of Suzy PLC since the incorporation of that company. The statement of financial position of the dual companies as at 31st December 2015 were as follows. Statement of financial position as at 31st December 2015. Pali PLC and Suzy PLC. Non-current assets in millions. Property, plant and equipment 110 Pali, 120 Suzy. Investments in Suzy PLC 100 million Pali. Current assets, inventory 30 Pali, 45 Suzy. Trade receivables 15 Pali, 12 Suzy. Bank current account Suzy 10 under Pali. Bank 5, 7 Pali and Suzy respectively. Total asset 270 Pali, 184 Suzy. Equity and liabilities. Equity original share at 50 kobo per shares, 80 Pali, 100 Suzy. Retained earnings 140 Pali, 60 Suzy. Current liabilities trade receivable, trade payable 50 Pali, 14 Susie, current account Pali 10. Pali, Susie, under Susie 10. Total equity and liability 270 Pali 184 Susie PLC.
Okay, thank you. Now, when you look at this question, critically look at it. What do you believe is unique about this question, and what do you expect us to do in solving the problem? Who will guide us? I'm waiting. Okay, let me give you a guidance. Now, if you look at this information, what is unique there is that they are able to separate trade receivable probably from third parties, from trade receivable from related party, which they characterized as current account, and which they put emphasis there that though this is a current account receivable by Pali in his book, but where it's receivable from is from Susie. And who is Susie to Pali? Is a subsidiary of Pali. And correspondingly, you can see here that even though they separated the trade payable to third parties from the trade payable in the books of the subsidiary, which is Susie, to Pali, which serve as a current account, the same 10 million is reflected here, which means in one aspect of the group is a receivable, which is an asset of 10 million. In the corresponding asset aspect of the group, it is seen as a payable in the books of the subsidiary as a liability. And this is what we mean by the intercompany balance. What then do we do? Is find a way of canceling this 10 out against this 10 before we proceed on consolidation. Now, to do that, we use accounting entries to do that, and that will be reflected in our spreadsheet here. Now, the question has been imported, and as you can see here, we have the question here. Now, all other information remains the same with respect to acquisition and everything, but except for the fact that, okay, they are all the same, okay, except for the fact that there's intercompany balance. In this case, there's no adjustment for unrealized profit, except for the fact that there's intercompany balance. Therefore, I need this off first and have it as blank so that I can do what is needful. And these adjustments are no longer required, as the case may be. Now let's go back. All other information here remain the same because it has not changed from what we had before, which means the group structure remains the same, and accounting for goodwill and non-controlling interest at acquisition remain the same. Now, what adjustment do we need? We require no other adjustments other than eliminating intercompany balance. In this case, what then do we do? We take care of that effect by adjusting for that's intercompany balance. Now I'll come here to create an adjustment to eliminate intercompany balances. Now, what are intercompany balances in this case? These are balances between the parent and the subsidiary. And to do that, I'll ask myself, who is owing who? Here, parent has a receivable from subsidiary. It means the subsidiary is owing, and parent is a creditor in this case to the subsidiary, which then means that parent has a receivable. For us to eliminate this current account receivable, which is an asset with a debit balance of 10 million, the only way you eliminate it or reduce it is to credit it, which is by accounting entry. Therefore, we'll come here and say accounting entry. Debit. Debit what? You debit the payable account because it's a liability account. Because when you debit an asset, an account that has a credit balance, what you are doing to dot such a balance is that you are reducing it. Therefore, we'll come here and say SUSI's current account payable to Pali, and Pali's current account receivable from who? From Susan. Okay, in that light, what happens? In that light, what we are simply doing is to eliminate this 10 million. Eliminate this 10 million. Okay. Therefore, carry it out. And what this means is that upon consolidation, let's go back. 110 and 120 give me 230. Intangible asset goodwill is here at 20. Inventory 30 and 45. $30 and 45, 75. Trade receivable 15 and 12, 27. We have current accounts, therefore I can clear this line. Current accounts. I have 10 for Pali. Here, under the receivable, I have is 0. Therefore, I put a 0, and we have to make an adjustment. Remember, we said we should credit it. And crediting an asset account means you are reducing it by that amount. Therefore, I'll come here and say minus 10. And this 10 is coming from the fact that I need to eliminate it from the parent's book.
Where is the zero coming from?
As I've said, you can see here there's no value, which means Susie does not have any current account receivable from any member of a group. This is zero now, your blank space. It means it's
Okay.
zero value. Okay. Now, this is 10 minus this 10 plus 0. What we have simply done here is that we have successfully eliminated it on a standalone basis. Therefore, let me strike it out with a line. Okay. That's it. I've struck it out. And we proceeded to consolidating. And these are our position. Now let's look at the other side. Share capital remain at 80. Retained earnings at 188, as you can find it here, because all other information remain the same. Our NCI also remain at 32, as all other information remain the same. Now our trade payable is 5014. And I create another line for current account. Now I have a 0, which is a parent, plus subsidiary, which is 10 minus 10. Remember, the subsidiary was 10. Can you see it here? The parent was 0. That's why 0 and 10. But we are saying that we should eliminate the 10 of subsidiary from the account payable. Okay. In that case, what do I do? It means when you come there, it is 0 plus 10 minus this 10. At the end of the day, you are still striking it out. Which means invariably, when I sum that up, I have 64 plus 0 will give me 0. So it will give me 64, yeah. And upon consolidation, I have this. Okay, why is it giving me this? Is there cross-referencing? Okay, this way there's cross-reference. And that's it. Yeah. Okay. And that is the position, which means we've shown ourselves how to eliminate. Now be careful. Sometimes, instead of separating intercompany receivable and payable from trade receivable and payable with third parties, sometimes it might be lumped together. If they have been lumped together, it will contain in trade receivable and trade payable. Therefore, what you do, it will be trade receivable of the parent plus that of the subsidiary minus that 10 million, which is intercompany. Here too, you come to trade payable, 50 million plus 40 million minus intercompany 10, and you have a balance there. But because it is separated from third party, that's why everything zeroized. But in reality, sometimes it may not zeroize. Take note of that. Okay. Any question on that? And this is the simplest assumption we can have, where we assume that intercompany balance agrees. Now we'll look at a situation where they fail to agree. And where they fail to agree, what is critical is that we consider the first level adjustment, which is force them to agree. And in forcing them to agree, we can narrow it down to any of the three. But in practice, it's usually narrowed down to two, assuming there is no error. The first thing is to check for errors, whether errors in your account, to find out whether there are transposition, there are this or that, and some other things like that. Okay, but if it's not attributed to error, or part of it is attributed to error which you have corrected and you still have some balances, therefore you need to now narrow it down to two, remaining two, which are common in practice. One is cash in transit. What it means is that, imagine the first scenario we are looking at, which was 10 million intercompany balance. Sometime before the year end, the subsidiary has made payment through his bank transfer or bank fund transfer in the bank instruction. And the money has left the subsidiary's book, but the parent has not received it. Let's say the year end is 31st December. And on 30th, there was transfer of 2 million naira by the subsidiary to the parent. It has left the subsidiary's account, but it didn't impact the parent account until 3 days. And by count of 3 days, it's already January 2nd. And that means that at the year end, it is what impact the bank account that will be recognized, even though 2 days after, things have reconciled. But as at the reporting date, things will not reconcile. Financial statement of the parent will read that subsidiary is still owing so much, but the subsidiary financial statement will read that I'm owing less because I've made 2 million naira payment. Though that is not an issue subsequently, but as at the reporting date, it creates an imbalance situation. Therefore, for us to consolidate, we can't just eliminate imbalance situation. First, we must make it balanced by adjusting for that cash in transit, as if such issue never arise in the first place. In doing so, we then need to pass an adjustment with respect to cash in transit, which we mentioned earlier. But let's see how we do all of those things now. I want someone to take it up by reading this illustration, which will buttress our understanding. Who will volunteer to read? I'm still waiting.
So there is noise at my background, though. Sorry, I'm not able to.
Okay, let somebody else.
Okay. Okay. Illustration 8. We can equally exploit the situation where the current accounts of the parents and subsidiary do not agree, but attributed to cash in transit as at the reporting date, as illustrated below. Illustration 8. Pali PLC acquired 160 million of the shares of Suzy PLC since incorporation of the company. The statements of financial position of the two companies as at 31st December 2015 were as follows. Statement of financial position as at 31st December 2015. Non-current assets, property, plant and equipment, 110 million for Pali, 120 for Suzy. Investment in Suzy's PLC, 100 million. Current assets, inventories, 30 million in Pali, 45 million in Suzy. Accounts receivable, 15 million in Pali and 12 million in Suzy. Current accounts, Suzy, 10 million. Bank, 10 million in Pali, 7 in Suzy. Total assets, 270 million in Pali and 184 million in Suzy. Equities and liabilities. Equity ordinary shares at 50 naira per share. 80 million in Pali and 100 in Suzy. Retained earnings, 140 in Pali and 60 in Suzy. Current liabilities. Trade payables, 50 million in Pali and 16 million in Suzy. Current account Pali, 8 million. Total equity and liabilities, 270 in Pali and 184 in Suzy.
Thank you, sir. Now let's go back to our spreadsheet. Now we'll find out that from the question here, intercompany balances fail to agree. On one hand, the current account receivable from the books of Pali reflect that Suzy has indebtedness of 10. But in the current account payable in the books of Suzy, it says I'm only indebted to Pali to the tune of 8. But luckily here, they've more or less traced it and they found out that it is attributed to the fact that there was a cash in transit. Okay, and since there was a cash in transit, the first thing here is for us to carry out a conciliation. First, we are looking at balances in the individual books as per accounts, individual books at the reporting date. In Pali's book, Pali has it as receivable, Suzy has it as payable. $10 and $8. And we recognize that there is an accounting entry we need to pass to reflect the adjustments on cash in transit. Cash in transit is cash. It's only qualified to say it is hanging somewhere. Therefore, we need to recognize it as if it's our cash that we have at hand, or because it is just a timing issue. We finally got the cash. It was hanging, as you all know what it is. Which means in this case, let's assume that the cash has been actually received by the parent as at the reporting date. The entry the parent will have reflected is that his cash position will increase. Cash and bank will increase, which means it's going to impact the group cash. And in that case, parent has received the cash and it's going to reduce the receivable by the parent from the subsidiary, which means the group trade receivable. In this case, I'll call it current account receivable. In the books of the parents, we equally reduce. And therefore, what entry would that amount to? It amounts to the 2 million naira. And the 2 million naira was what we are able to trace as the difference between these two. Now, invariably, what we do is to effect that in our books. Effecting that in our books means we are reducing the receivable in the books of Pali. You say less cash in transit adjustment. Or because you are reducing it from the asset account. All things being equal, what do I have? I now have an agreed balance, agreed intercompany balance as at the reporting date, all because we agree now. Can you see our agreed balance? Therefore, this is a balance that has been agreed that we need to eliminate. Therefore, we come here that, okay, the balance I need to eliminate is not 10 million, but what? 8 million, either of the 8 million. That's what I'm eliminating. Now, this is on the premise that first I've made an adjustment for cash in transit to force the balance to agree, and therefore I eliminate. Now let's come back to our question. All other information remains the same, except for information in the balance sheet. But here we have 110 and 120, which is 230. Goodwill remains the same at 20. Now, inventory, we have 3045, yeah, that's 75. We have accounts receivable, 1512. Yeah, we have current account, 10 and 0, okay? But the first adjustment we are told to do here was adjustment to reduce the account receivable in the books of the parent by 2 million on the premise that they have actually or finally received the cash that was initially in transit. Therefore, I come here and say I minus 2. When I minus 2, it still remains 8. Okay? Now, what then do I need to do is that I now find that the 8 is this 8 million that I need to eliminate as intercompany account receivable. And to do that, I come up here and eliminate the 8. Now, at the end of the day, you come here and say 10 million minus 2 minus 8. You can see current account receivable credit pali and current account receivable again credit pali. Therefore, it's 8. At the end of the day, what do you have? You have 0. Now, when we come to current account payable, we only have 0 and 8 here originally. And therefore, what is intercompany balance we are knocking out? It's no longer 10, but agreed balance of 8, which I now put here as 8. Therefore, on that premise, I come here to say 0 plus 10 minus agreed balance, which is no longer 10, but 8. And that should give me 0. That means 0 plus 8 minus 8 will give me 0. And that's the position here. At the end of the day, we now have our balance sheet agreeing after effecting cash in transit adjustment. Otherwise, if we have not done this adjustment, you'll find out that the intercompany balance will not totally cancel out, and thereby creating a problem for us not being able to reflect the economic units of the group from a financial position perspective. Now, that is that. Any question? Now, the beauty of it is that I assume that the cash was actually received at the reporting date. But what if the cash were not actually received? What would have been the entry I will have passed? The entry will be that, let's say the cash returned to the subsidiary. The entry is for me to duplicate this and see what the position will look like. I'll call this B. And the first one is A. If we treat it as if the subsidiary has the money returned to the subsidiary, what then happens is that the cash returns to subsidiary. It then means that it's no longer parent that will reflect the cash in his book. It will be the subsidiary. And the subsidiary will now acknowledge that I'm no longer owing 8 since the bank returned my money, but now I'm owing 10. Therefore, this will now be reflected in the books of the subsidiary. And when you credit your account that's already a credit balance, what you're simply doing is that you are growing that balance from 8 to 10. Which that means that instead of saying less here, it will be add the cash in transit adjustments to where you are adding it to the books of the subsidiary. What then you have? You have a agreed balance of 10. The subsidiary is now correcting that, yes, though I transferred, but the bank has returned the money. Therefore, I've restated my value. Since I've gotten my money back, I'm now owing you 10 million. In that case, what then now happens? In elimination, we'll come here and say, there is no adjustment here other than we eliminating that common term. And doing so is for us to come here and say, we are adjusting for the common item there, which is this 10, and which gives us a 0. And here, though it was initially 8, but there was an adjustment when the money was returned to me of 2, And therefore, that necessitated the elimination of intercompany balance as agreed as 10. In that case, what happened? That gives us a position of what we have 10, 8, plus, if you remember, we now have to grow the 8 back to 10 and now subtract the intercompany balance of 10. And that gives us a 0. And that is a position if you have to treat it otherwise. And that's why you find out that in the material I presented to you, it was clearly stated there that regardless of the order you adopt, your position will remain the same. And I want somebody to read this again. Can somebody read this again?
Sorry, intergroup current accounts. There are situations where the parent and subsidiary maintain current accounts. Intercompany receivables and payables for tracking the intercompany balances and remittance of funds made on transaction between the duo, parent and subsidiary. It is always expected that since the current account maintained by parent and subsidiary accommodate the remittance of funds between them, then balances should agree at all times as the account minor each other. If the current account do not agree, it means there may be some elements of accounting error that must be corrected or some transaction considered to be in transit, such as cash in transit and goods in transit. Prior to consolidation, the balances are required to be reconciled and necessary adjustments should be effected before consolidation. Upon consolidation, it is a requirement that intercompany balances should be cancelled out. This is to ensure that the economy and financial position performance and cash flow of the group as a single economic unit are reflected in the consolidated financial statements. Where the adjustments for cash in transit and all goods in transit are required and for the purpose of the reconciliation of intercompany balance, that is current accounts, the following accounting entry is required. Accounting entries for recognition of cash inventory in transit, debit group cash and bank inventory, credit current account, either of the current account as they ultimately be cancelled out with the amount of cash and or goods in transit. That's all. I'm done reading.
Yes, thank you. Now, what I'm saying is that that expression is what I've proved with various illustrations of saying that we can always see that position in the light it is. Okay. Now, let's move further to what if the adjustment is not cash in transit, but they found out that the imbalance was attributed to goods in transit. The same question. The only thing is that they told us that the imbalance was solely of goods in transit. Can somebody read the question? And let us see what will have been different if it has been goods in transit.
We can equally explore the situation.
We can equally explore the situation where the current accounts of the parent and subsidiary do not agree, but attributed to goods in transit as the reporting date. As illustrated below, illustration 9, Pali PLC acquired 160 million of the shares of Suzy PLC since the incorporation of that company. The statement of financial position of the dual companies are as at 31st December 2015 were as follows. Statement of financial position as at 31st December 2015. Non-current assets. Valid. Property, plant and equipment, 110 million naira, and Suzy, 120 million. Investment in Suzy PLC, 100 million. Current assets, inventory, 30 million Palin, 45 million Suzy. Trade receivables, 15 million Pali and 12 million Suzy. Current account, Suzy, 10 million. Bank, 5 million Pali and Suzy, 7 million. Total assets, 270 million Pali and 184 Suzy. Equities and liabilities. Equity, ordinary shares, 50 naira per share, 80 million Pali and 100 million Suzy. Retained earnings, 140 million Palis and 860 million Suzy. Current liabilities, trade payables, 50 million Pali, 60 million Suzy. Current account, Pali, nil, and in Suzy PLC, 80 million. Total equity and liability, 270 Pali and 184 Suzy.
Okay, thank you. Now let's switch back to our spreadsheet. Now, the only difference here include one. Instead of us considering that the difference is attributed to cash in transit, we'll treat it as goods in transit. You can see what I'm doing here. But the adjustment remains the same, except for the fact that account impacted will no longer be group cash and bank, but it will be group inventory. But the current account remains the same. Which means here, instead of us adjusting against cash in transit, okay, even in the first one, did we adjust against cash in transit? No. Okay, let's come back to the first one. During the period of cash in transit, this was 16. We didn't take that into cognizance. We didn't take that into cognizance. This is 50 and 16, not 50 and 14, which means 50 and 16 will have given us 66. And that would not make it agree. Why? Because we have not adjusted against the bank. We now come to the bank, and remember, we said we should increase the bank balance by 2. You now come here to increase it by 2. Let me asterisk it, bolding it in red to show the adjustment you have made to cash with respect to that. Therefore, this will now be 5 plus 7 plus increment in our cash, which is 2. That's 116. This same adjustment here is what is reflected even in the second one we did then, having discovered that this is 16 and not 14, which means I'm just linking it here, which means the difference here is that we are adjusting against bank in both cases because it's a bank that the amount of cash was understated because of the in-transit. You transfer, you didn't get to the person you transferred to, and you didn't get your money back. And that's what we have effected here. And we are not getting the money back, and that's what we've done at both instances. But instead of doing that to bank, we'll be doing that to inventory. Now remember, our payable year was 16. From here, which is 16 and 50, that gives us 15 and 60, give us 66. But our account did not agree or balance because we've not taken cognizance of adjusting for cash in, for goods in transit. If you remember, the 2 million, is what we adjust for. in order to recognize the inventory in transit, okay, which is 2 million here. And that will give us some 7, and that's how it agrees. And which is the same thing we can replicate from the perspective of if we treat the transaction as if the goods were returned back to the parent, and in that situation, the balances were adjusted appropriately. So, which means either of the case, you have the same position. But what I'm just trying to do is that instead of adjusting for bank, we are adjusting for inventory, which is what you can see here. Inventory as against bank. But I'll not tell you one further adjustment that might affect the goods in transit, which in this case did not, is that in this case, we have assumed that even when the parent was transferring the goods, it transferred the goods at cost. Therefore, as the goods are returning, it's also returning at cost. But what if the parent transferred the goods at cost plus profit? If the goods are returning, they are returning at cost plus profit, which now compound our problem because these goods have not been sold to third party. And profit that was already initialized and recognized by the parent has now come back to us, which then means that there's an element of unrealized profit on goods in transit, provided it was transferred at cost plus profit. Which means in that case, in addition to this adjustment, we also try to eliminate unrealized profit on the inventory of the group. Otherwise, we'll be overstating our profits as a group and overstating our inventory as a group. But that adjustment is not required here because there is an assumption here. Let me state it here. Assumption that the goods in transit at initial point of sale or transfer within the group was at cost, which means the transfer price was at cost. Now let's take note of that. Okay. Any other question? Now, similarly, if you go to the material, you can also have other similar examples, including management services accrued for, how you carry out such adjustment. For example, accrued intra-group service charges and income. Companies within the group sometimes render a different form of services to one another. These services may include, but not limited to, those identified below: shared and management services, training and development of personnel, intergroup hire of assets. In the individual financial statement of the entities, parent company and the subsidiary, the expenses incurred and income earned on these intragroup transactions, as stated above, will have to be accrued as appropriate, especially prior to invoicing. In the process of consolidation, the accrued intergroup expense and income, which constitute a balance sheet item, will have to be cancelled out, as this will make the financial statement of the group more fairly presented and depict the group true financial position as of the reporting date. Therefore, you have similar transactions here: accrued income due from SUSI 4. You have accrued expense due to PALI 4. What do? You eliminate. These are practical examples of what we could have. Other ones are like bill of exchange, whether it's discounted or not discounted, it constitutes intergroup balance. Now, for example, here I said there are instances where bills are exchanged as a means of acknowledging indebtedness and demonstration of willingness and ability of the indebted party within the group to pay the order in absent manner. On one side is bills receivable. On the other side is bills payable. These transactions sometimes involve two or more companies within the group. There are two possible scenarios applicable or possible when bills of exchange surface in the statement of financial position of the parent and subsidiary, which include: one, where there are no intra-group bills. The bill to be shown in the statement of financial position is that of the group, either by the parent or subsidiary or both. Where there is an element of intra-group bills, the bills to be shown in the statement of financial position is that of the parent and subsidiary, less any intra-group bills. And for example, here you have bills receivable, of which 2 million is receivable from SUSI. And here you have bills payable, of which 2 million is payable to PALI, which means in this case, upon consolidation, you eliminate 2 from this and 2 from this. But we also have instances where the bills may have been discounted prior to reporting date. And in that situation, what do? You identify the component discounted, which is no longer intra-group, or because a third party has discounted the bill, it now becomes indebtedness outside the group. And in that situation, what happens? Bills of exchange discounted. As the bills of exchange is a negotiable instrument, it could be discounted. A bill receivable by a company can be discounted as a negotiable instrument in order to raise immediate cash for liquidity purposes. Discounting of bills involve the holder of a bill, bills receivable, who is a creditor, will approach a discount house or a financial institution prior to its maturity for immediate access to fund or cash. The discount house then takes ownership of the bills, which will be presented as the bearer at the due date to the debtors. Discounting of bill implies that the original creditor, the writer of the bill, obtains an amount lower than the face value of the bill, while the balance represents the discount retained by the finance house as commission or interest on discounting of the bills. An intercompany bills receivable by a company within a group shall be discounted with a third party financial institution in order to raise short-term cash and or liquidity. Hence, the portion of the bill discounted will no longer constitute intercompany balance. Rather, it is a portion of the intercompany bills now payable to a third party. In this case, it becomes a liability to the group. What we are saying here is this. Of these 7 million bills, 2 million is due from Chelsea, and Chelsea is a subsidiary of Barcelona. Whereas in the books of Chelsea, it's showing that he has bill payable of 3 million due to Barcelona out of this 10 million. Now, what is the difference between the 3 million claimed by Chelsea being owed to Barcelona and 2 million being claimed by Barcelona receivable from Chelsea of 2 million? When we investigate this, we had additional information that Barcelona during the reporting period discounted 1 million tranche of the bill from Chelsea, which made it to only recognize 2 million as balance due because he has already traded this 1 million with financial institution unknown to Chelsea because it's a negotiable instrument and tradable instrument. Now, it then means that Chelsea needs to realize that this 3 million is not entirely owed to Barcelona again, but 2 million to Barcelona and 1 million to that financial institution, which is more or less a third party, to which Barcelona has negotiated and gotten immediate value from. Which then means that intercompany balance is only 2 million, not 3 million again, because 1 million has been transferred to an independent third party. In that case, the only portion you eliminate is the 2 million, which you see here. Now, look at this illustration here. It says that in order to cancel out the intragroup bills as maintained by the parent and subsidiary, we first ensure that the intragroup bill of 2 million receivable by the parent are cancelled out as against 3 million initially payable to the parent, as the difference or balance of 1 million is now owed and payable by the subsidiary to third party, the discount of finance house, and invariably this constitutes a liability to the group. And that's what we've done here, which means intercompany is just restricted to the undiscounted element of the bill and not the discounted or the total. And that's the position there, which is what was reflected in this balance sheet as bills receivable to eliminated to eliminated. And that's just a position there, which you need to take into consideration. Okay, now the next aspect which we'll be discussing is intragroup loans, which also constitute balance. And later on, we'll discuss on dividend payable and receivable within the group. Okay, now with respect to intercompany loan, where there's financing arrangements within the group, the financing arrangement creates a loan receivable from the angle of the lender and loan payable from the angle of the borrower. And in that situation, they constitute intercompany balances. And what then do you need to do is to eliminate the intercompany balance. And this is premised on the fact that the balances agree. And if they don't agree, you need to trace it. It can be as a result of one, treatment of intercompany interest on loans, which sometimes they are not treated in the same manner based on the fact that some entity might treat the loan balance separately from the interest accrual, which has remained unpaid. And sometimes it might be differences arising from the fact that the classification with respect to financial asset in the hands of the lender may be at fair value, whereas in the hands of the borrower may be at amortized cost. But all of this must be adjusted for so that the treatment are the same in order to agree to balance and henceforth eliminate that balance. Now, I want somebody to read this out and we'll demonstrate in practical sense how this can be done by way of elimination. Can somebody read intercompany loans?
Intracompany loans. There are situations where the parent extends borrowings to its subsidiary in order to boost further the operations, performance, and positions of the subsidiary. If the parent invests in the borrowings of the subsidiary, then effectively the parent has lent cash to the subsidiary. The parent's investments in the borrowings of the subsidiary is effectively a financial asset to the parent, and this should be cancelled out on consolidation against the relevant borrowings, which is financial liabilities, in the subsidiary's book. Loan or debt instrument within the group should be cancelled out upon consolidation. Any accrued interest income by the parent and accrued interest expense by the subsidiary should equally be aggregated with the principal portion, either at amortized cost or fair value, and thereafter cancelled out upon consolidation. However, the amount of bonds/loans not held by the parents will not be part of the non-controlling interest, as they do not bestow any right of ownership by the shareholders. They are effectively considered a form of a long-term loan, which is a financial liability and will be shown as such in the consolidated statement of financial position. Furthermore, in a situation where the preference shares are recognized as a liability of the subsidiary under IAS 32 financial instruments presentation, they should be accounted for in the same way as loan notes, which includes debts and or bonds, invariably upon consolidations. The preference shares acquired or purchased by the parent and includes in the cost of investment, that is, investment in the subsidiary as contained in the separate statement of financial position of the parent company should be cancelled out against the preference share capital in the subsidiary, while in the portion that is not held by the parents will be treated as a liability to the group and not as a component of non-controlling interest. This is because non-controlling interest is a component of equity, whereas a preference share equally redeemable and all cumulative preference share may have been classified in accordance with IAS 32, a financial liability. Illustration 13. Arsenal acquired 70% of its ordinary shares of Manchester United on 31st December 2013, when the balance in the later retained earnings stood at 40 million naira at a consideration of 220 million naira, and also invested the sum of 100 million naira in the 10% loan notes of the subsidiary. Statement of financial position as of 31st December 2015. Arsenal and Man United. Property, plants and equipment. 50 million for Arsenal, 260 million for Man United. Investment in Man United is 220 million. Current assets, Arsenal 260 million, Man United 280 million. Total assets is 1,140,000. Man United 540,000. Share capital and reserves. Equity share capital 600 million for Arsenal, the Man United 250 million. 8% preferred share capital 100 million for Arsenal. 100 million for Arsenal. They retain earnings 290 million for Arsenal, 50 million for Man United. Total equity is 990 for Arsenal, 300 for Man United. Non-current liability, which is the venture, is 0 for Arsenal and 120 million for Man United. Current liabilities, Arsenal 150 million, Man United 220 million. Thank you.
Okay, thank you so much. Thank you so much. Okay, now we are going to try and solve this problem. And what I've done is to put it on our spreadsheet. Now the structure is 70% ownership. Therefore, if it's 70%, that means NCI will be 30%. Now let's try and put up the structure in our notes. I will copy it back. The group structure in this case Arsenal has 70% stake in Manchester United. NCI then is 30%. Date of acquisition was set to be 31st December 2013. And we are reporting on 31st December 2015. When you check the dates, they are 2 years apart. On this premise, I can copy this take it to our spreadsheet. Therefore, the information here will not be relevant. Perhaps I can take that out. Okay, no, some of them are relevant. This one that's not relevant, which I can take out. I just put this here. Take up the space. Okay. Now, that is how we got 70/30. What was the reserve at acquisition? The reserve at acquisition was 40. I put 40. And reserve today is 50. I'll put 50. Sorry, not there. 50. Okay. Now, investments. Okay, there are information about preference share. Let me just go and copy the template of preference share. Or let me use that template straight forward so that I don't waste my time. That was the template. We had preference share. Okay, this was the template. Therefore, let me replicate this. Okay. Let me just copy the question here. Okay. Okay. It's still the same thing. Okay. That's the template. Now, 40 million. There's something. Okay. Now, investment in Suzy. That's ordinary shares of Suzy. Was 100 million. No, sorry, 20 million. Okay. And the ordinary share capital of Suzy was 250.
It's Man United, not Suzy.
Okay, of Man United, yeah. So okay, there's no even preference share in the, okay, there's no investment in preference share. Therefore, I don't need to use the template. Let me go back to the first one. There's no investment in it. I thought the subsidiary has preference share, but in the question it doesn't. Therefore, I can just continue with this. Now, what I have investment in Manchester United. I changed everything here to Manchester United. And that's why when you're creating templates, you don't need to put it there, you just put subsidiary so that it makes things much more easier for you, or you more or less dynamically link the name so that it changes at every point in time. Okay, now the investment in Manchester United is 320, but of which 220 is equity investment, and that's what matters. I emphasize this is equity investment. Okay, ordinary share capital of Man U is 250, and reserve asset acquisition was set to be 40, which is linked. And reserve asset reporting is 50, which we've done, and that's why we have post-acquisition of 10. Okay, that is that. Now, the other aspect of this 320, for example, if you go back to this investment, which is financial assets, what we have is 320. And if you eliminate the 220, which we are going to eliminate here, check, there should be a balance of 10 million here, which is 320 minus 220. What is left is 100. Now, this now shows intercompany balance of loan that Arsenal has in Man U. But because it's intercompany balance, we have to eliminate. Therefore, we'll come back to this. Let me just highlight it in red first, so that we'll come back to that. Now, let's continue other things. Purchase consideration of Arsenal is 220, which is already linked. Now, ordinary share capital of Manchester United is 250, which is already linked. Pre-acquisition reserve is 40, which is already linked. No fair value adjustment, which is linked. And automatically, what do we have? The net asset is 290. And upon measurement of 20% of 290, which is measured at proportionate share, is what gives us 87. Now let's check. 30% of 290 is 87, as highlighted. Now, the post-acquisition profit is 10, and you take ratio 70-30. That is what gave us 3 at 30%, and 7 at 70% of 10. Okay, we can check it also. 30 of 10 and 70 of 10. Okay, this is what gives us all of this position of goodwill and the likes. Now, let's continue. Now, let's try to consolidate PPE. We have 560. And you have 260. When you do that, it is 560 plus 260 will give us 820. Goodwill we said is 17. Current assets, we have, okay, current asset is marked together. Therefore, in this case, let me just consolidate it together. It's not splitted. If I come here and say current assets, what do you have? 260 and 280. 260 and 280. 260 and 280 will give you 540. You sum it together, you have 1477. Now, share capital of Arsenal only is 600. Consolidated retained earnings. What was the reserve? 290. We need to change that. This 290. 290, which means 297. Equity is 90, all things being equal. Now, debenture, we have 0, the parent has no debenture, the subsidiary has debenture of 120, which is a loan note. Therefore, the group has 0 plus 120. Payable, current liabilities, we have 150 and 220. 150 and 220. That's 370. If you add everything together, it gives you this. Now, in our minds, we are correct. But I can tell you that it is not totally correct, and we can tell me why. What is presented, even though it's balanced, still did not reflect the consolidated financial position. Who can tell me why?
No idea from me.
Yeah? Who can tell me why? Now, it is because we have intercompany balance that has not been eliminated. Remember, when the subsidiary issue bonds, the parent also subscribed to 100 million of that bond out of the 120 million that you can see here. The parent subscribed to what? 100. It was that 100, which is by way of lending, plus 220 that make up 320. Now, this 320, after eliminating 220, it left with 100. And this 100 is also reflected in this 120, all because on the side of the subsidiary is a borrowing of 120, which comprises of 100 from the parent and 20 from external people. Now, what that means is that the intercompany loan, which on this side is loan receivable, non-current assets, because it's spanned for more than 1 year, and on this side is loan payable on the aspect of the subsidiary. Therefore, the intercompany aspect is the loan or financing arrangement within the group, which is 100. Hence, what adjustment will I do to eliminate intercompany loan balances? And to do that is that the subsidiary's loan account as a payable to Pali will be cancelled out against Pali's.
Arsenal and United is United.
Okay, thank you for the name. Which means in this case, Manchester United loan payable account will be cancelled against Arsenal loan receivable account. And in this case, And in this case, what then do we do? We eliminate. How much are we eliminating? Intercompany, which is 100. And in doing so, I'll come here and say less 100. And here we have 1377. Here is still 1477. Why? Because we've not come here to carry out the corresponding adjustments. Which is minus this 100. And this is how we eliminate intercompany loan. Similar to the same way we've done for intercompany balances with respect to payable and receivable. Any question on that?
Yes, please. The preferred share capital in the book of the parent, I don't think we consider it.
Okay, therefore let's go back there. Preferred share capital in the parent, okay? Yeah, we omitted it. Let me create that line. We have 8% preferred share capital. Which is also for us now only. How much is it? 100.
Right.
Okay, therefore go back here, 560 and 260. 320, we have 260 and 280. Okay. Now we have 290. Yeah. We have 150 and 220. Okay. Therefore, can you cast this balance sheet and see whether it agrees? Okay, yeah, the aspect of the mind you will not agree because this is supposed to be, it's not 220. If you look at 220, it's going to be higher than the balance sheet. It doesn't, it's not 220, it's 120. Now look at it here.
Yes, yes.
This is not 220. It's wrong for us to say it's 220. Okay, therefore, let me paint it and write one there. This is 120. I'm trying to write it. $120. Oh, wait, let me just to make it easy for myself. Okay. Does that make sense? Which means I come here, this not 220, is also 120. Therefore, your first point of call is to check whether what you have here is okay, which we have addressed now. Okay, any other question? Now let's now look at the aspect that speaks to dividend. Now, when subsidiary declare dividend and it has been appropriately approved by the shareholders of the subsidiary, automatically that action has created and has established the right to receiving dividend by the parent and other shareholders which are non-controlling interest from the subsidiary. And in that light, the subsidiary will be indebted and have to recognize dividend payable, and the parent have to recognize dividend receivable. If this thing remain unpaid as at the reporting date, they constitute intercompany balance and they have to be eliminated. Okay, how do you go ahead to eliminate it? And what happens to the portion of dividend payable by the subsidiary, and that portion is due to non-controlling interest, which are other shareholders other than the parent? Such will constitute liability to the group, as will be reported within the current liability in the consolidated statement of financial position. And how do we do that? We will demonstrate with an illustration. But before then, I want somebody to read this up. I will move on from there. Who volunteers to read?
Dividends analysis. If parent is expected to earn return from its investment in a subsidiary, and part of the returns earned in a subsidiary is the dividends received from the subsidiary, dividends paid by a company is due or payable to all shareholders of the company. It then implies that where the subsidiary is partly acquired / owned the parent, the dividends declared paid or payable is due to both the parents and the non-controlling interest. That is, if the subsidiary has a proposed dividend at the reporting date, then some of this is payable to the parent and also to the non-controlling interest based on the proportion of shares held at the reporting date. Technical notes: IFRS 10 reversed events after the reporting date, proposed dividends declared after the reporting period, balance sheet date, or not to be recognized as a liability, and dividends are to be debited against retained earnings when they are paid. It implies that if dividends have been declared prior to the reporting of balance sheet date, such constitutes a liability as at the reporting / balance sheet date, in line with the provision of IAS 37, provisions, contingent liability, and contingent assets. When dividends are declared by the subsidiary, both the parents and the non-controlling interest are entitled to their own shares, which is derived based on the percentage holdings in the subsidiary. Some situation exists where dividends are paid either from pre-acquisition profits or post-acquisition profits. But the current position of IFRS requires the same treatment as dividend is only considered as a return on investment, as against the proud distinction between dividend being either a return on investment or a return on investment. Further, in this text, the old position will be considered immediately after the consideration of the current requirement in a bid to appreciate the dynamism of the paradigm shifts by the ISB in its consideration to first evidence in the revision made at IS 27, 2008. The new position of IS 27 reversed 2008, which further flows into IFRS 10, now requires the treatment of dividends received or receivable from the subsidiary as a return on the parent's investment, regardless of whether it is paid declared from pre-acquisition profits or post-acquisition profits. The implication is that goodwill is no longer affected with the old principles of reduction of cost of investment with the dividends paid out of pre-acquisition profits. Consider the pre-acquisition dividends. If the parent has not recognized the dividends received or receivable from the subsidiary in its separate financial statement, it is more preferable to adjust the financial statements of the parent before proceeding with the consolidation. Or alternatively, we adjust for the dividends of consolidation based on the principles of consolidation as it relates to dividends paid, whether from pre-acquisition profits or post-acquisition profits. The same treatment is accorded. Debit bank if received / dividends receivable if it is outstanding. Then you credit statement of profit or loss of the parents or income statement with the parent share of dividend payable declared or paid by the subsidiary. Illustration 17.
Can we look at this illustration?
Okay. Should I go ahead and read them? Illustration 17. Faramade PLC acquired 80% of the shares of Adebola PLC as at 30th December 2016. Faramade PLC was included in the registered of shareholders in Adebola PLC before the registered was closed and before the declaration date, the 1st December 2016, of dividend by Adebola PLC, which coincide with the reporting date. And this makes Faramade PLC entitled to dividends of Adebola PLC as at the year ended 31st December 2015, as the amount of dividend is still outstanding. Statement of financial position at 31st December 2016. Faramade PLC, all in millions of naira. Adebola PLC, also in millions of naira. Non-current assets, property, plants and equipment, 90 for Faramade, 120 for Adebola. Investment in Adebola PLC is 140 million. Current assets, inventories, Faramade 25 million, Adebola 45 million. Account receivables, Faramade PLC 12 million, Adebola 12 million. Dividend receivables, 8 million for Faramade. Bank, 5 million for Faramade and 7 million for Adebola PLC. Total asset is 280 million for Faramade PLC and 184 million for Adebola PLC. Equities and liability. Equity, ordinary shares at 50 kobo per share, 80 million for Faramade PLC and 100 for Adebola PLC. Retained earnings, 140 for Faramade and 60 for Adebola. Current liabilities, account payable, 40 million for Faramade PLC and 14 million for Adebola PLC. Dividends payable, 20 million for Faramade PLC and 10 million for Adebola PLC. Total equity and liability, 280 for Faramade PLC and 184 for Adebola PLC required to pay the consolidated statement of financial position as of 31st December 2010. So is this 2010, is it right? It says the requirements, sir.
Okay. The requirement is 2015. We'll correct for that. It's 2015. Okay, now let's transfer that to our spreadsheet. Now let's correct for that. Okay, as at 2015. Now let's try and put up our structure. Let me put somewhere here. My pen is tired. I think I might just same, trying to draw it up. Okay, let me just see that, but since you understand that structure before, I'll just take it off. Okay, now let's pick the information one by one. Now, acquisition took effect on 30th of December 2016. And we are reporting, okay, even this date is not correct. Is this date that is not correct? 31st of, is 2016, not 2015. It's 2016, not 2015. Let me go back there. $2015. Okay. No, sorry. $2016, yeah. Okay, given that it's 2016, and this too is 2016, not 15. Okay. Now, what that means that a date to the reporting date is when we acquired, and as at that date, there were dividend declared in which we will be a beneficiary. In that scenario, what happens? How do we consolidate? Now, what is our stake? Our stake is 80%, and NCI is 20%. Therefore, reserve as at acquisition will be the same reserve as at the reporting date, which is 60. And in that case, we have no post-acquisition. What's the share capital investment we made in Adebola is 140. What's the ordinary share capital in Adebola is 100, and pre-acquisition reserve is 60. Which is this 60, we can equally link it. Now, the purchase consideration of Farmady in Adebola is 140, is linked. Ordinary share capital is 100, is linked. Also, preference pre-acquisition reserve is 60, is linked, and our net asset at acquisition is 160. Now from there, we are able to measure NCI at 20% of 160. And that's how we obtain this 32, which you can see from this link. Yeah. Now, upon that, NCI is 32, post-acquisition profit, there's no profit, therefore, this is 0, and likewise, this also is 0. Anything of 0 is 0. Now, what's retained earnings for 140, which is what we have here. And consolidating, we have PP 90 and 120, property, plant and equipment. 90 and 120 will give us what? Give us 210, 90. Goodwill, we've linked it, that is 12. Inventory, we have 25 and 45. Trade receivable, we have 12 and 12. Dividend receivable, in this case, we have 8 and 0. We'll come back to that because we'll trace where the dividend is coming from and see whether it's intercompany so that I can aid our elimination. Bank, 5 and 7, that is 12. This is 8 and 0. Now, share capital of the parent is 80. Consolidated retained earnings is 140, linked. NCI is 32, linked. Current liabilities, we have account payable 40 and 14. That should be 54. We also have dividend payable. Which is 20 and 10. Again, we'll still investigate and see which portion is intercompany for elimination. Now, even though the balance sheet agrees, but it's not mere agreement that matters, but of the economic substance. Therefore, what is the issue? We need to carry out dividend analysis and see what portion of the dividend as declared from the perspective of the subsidiary that constitutes intercompany balance. Dividend analysis okay, I'm coming. The analysis of the subsidiaries position as at the reporting date. Now we look up and ask ourselves, how much was the dividend declared? By the parents. And the answer here is sorry, by the subsidiary, not the parent. The amount declared is in naira. From the information given to us, is 10 million. You can see it here, dividend payable. And that 10 million is payable to who? Now 10 million naira is payable to the shareholders who is the dividend payable to. My answer there is it is payable to the subsidiaries shareholders. Who are the subsidiary shareholders? I'll say the subsidiary shareholders, they are the parent, which in this case is Amade, and others, which in this case they are non-controlling interests. And if you remember, dividend is paid equally per share. And what that simply implies is that each shareholder will collect the same amount of dividend per share, but the number of shares is what will determine your absolute amount, which then means that hence, what portion of the dividend is receivable by the duo below. Who are the duo? One, the parents, and two, others, which in this case is the non-controlling interest. Now the parent will do what? The parent is entitled to 80% being a stake of the 10 million, which amount to 80% of 10 million. And this amount to that amount to 8 million. Now, NCR will take 20% of the 10 million. Which also amount to 2 million by the time you do your calculation. 20% of 10 million. Therefore, what is intercompany? Therefore, the intercompany dividend balance, receivable versus payable, is the 8 million. That's a common factor. It's a common factor between the parent and subsidiary. That's a common factor. Okay. Now we've seen how we determine this, and we can now come back and say adjustment to eliminate intercompany dividend balances. In the hands of the parent, it's a receivable, therefore, and it has a debit balance. What then do? You credit it. Dividend receivable from the subsidiary. And that is the 8 million. And in the subsidiaries book, the parent is in the subsidiaries book, it is recorded as dividend payable. And in that case, it has a credit balance, and to eliminate it, you debit it. And that's what we've done here. And in doing that, that will now lead us to come here and say, in the dividend receivable, we are told to credit it. And doing so means we are reducing it. And by the time we reduce it by that, it becomes a zero, which means technically, like what I have here, I can borrow this as a format to format it. And that's how I got to zero. Also, when I come here, dividend payable I have was 20 and 10. Now I'm told to eliminate the 8, which by so doing, I come here, I have 20 plus 10 minus 8. Now you find out that between 10 and 8, there is two difference. That too, we have sent dividend payable to non-controlling interest. Okay. And that's why we said dividend payable to non-controlling interest constitute liability within the group. And here, I can borrow the same thing I have here. Okay. Now we can see what our position looks like at the end of the day. Any question on this? This is how we eliminate intercompany dividend, regardless of the position. Any other question?
No question.
Okay, let's see whether we can look at one more example. I will call it a day. Okay, let's look at this example. Can somebody read it out? I'm coming. Okay, you can proceed to read it. Illustration 18.
Faramadi PLC acquired 80% of shares of Adebola PLC at 31st December 2015, when the retained profits of the latter stood at 40 million naira. The statement of financial position of the dual entities are shown below. Statement of financial position at 31st December 2016 for Faramadi PLC, Adebola PLC. Non-current asset, property, plant and equipment. Faramadi 130, Adebola 120. Investment in Adebola PLC 100 million. Current assets, inventory 25 million, 45 million. Receivable 12 million for Faramadi, Adebola 12 million. Dividend receivable 8 million for Faramadi and none for Adebola. Bank 5 million for Faramadi and 7 million for Adebola PLC. Equity and liabilities. Equity ordinary shares 50 kobo per share, 80 million for Faramadi and 100 million for Adebola. Retained earnings 140 million for Faramadi and 60 million for Adebola. Current liabilities, account payable 40 million for Faramadi and 14 million for Adebola. Dividend payable 20 million for Faramadi and 10 million for Adebola. We are to approach the solution in the following steps. Step 1, determine the percentage holdings on investment of Faramadi PLC and Adebola as at the acquisition date, 31st December 2015, which represents the date of inclusion, first date of Yes, are you there?
Yeah, okay. Now, we have to proceed to solving the problem in similar approach. Therefore, I'm copying the question. I'm now going to put it on our spreadsheet. Now, the acquisition took place at 1st of March, at 1st of December 2015. 80% stake, which means it does not change. But then our reserve stood at 40. Pre-acquisition was 40 then and not 60. Ordinary share capital is still 100, and investment in Adebola is 100 in this case, not 140 again. Okay. Now, when we check here, what is unique is that we have dividend receivable of 8, dividend payable, parent 20, dividend payable, subsidiary 10. Now, we are only interested in the 10 of subsidiary, which is dividend analysis we are doing here. Now, the dividend analysis of subsidiary's position as at the reporting date, how much was declared was 10, it has not changed, and is payable to subsidiary shareholder, which comprises of the parent and NCI, non-controlling interest. Now, the parent has 80%, we are still taking the 80% of 10, and the NCI is 20. And that's how we arrive at 8, which is 80% of 10. And we arrive at 2, which is 20% of 10. Now, what constitutes intercompany is the 8 million, which is a common factor between the parent and the NCI and the subsidiary. And that constitutes the elimination we have here. The subsidiary has dividend payable, which is a liability, and we have to credit it to eliminate it. And the parent has dividend receivable, which is an asset of debit balance, and we have to credit it to eliminate it. That is what brought about this accounted entry. Now, in eliminating it, we'll find out that we have 8 already, and we are eliminating 8. That's why it's nil. The reason why you need to do this analysis is that it's possible that the dividend of this parent receivable is 9. If it is 9, our analysis shows intercompany 8. What then accounts for the difference between 9 and 8 is simply put that it's also possible that we will have other investments which we might have disposed of or are still outstanding that we also enjoy dividend from. But those investments do not constitute investment we have control, which means it's not a subsidiary. It can be ordinary simple investment or probably investment in asset and joint venture. What that means that the only portion of dividend you eliminate is a dividend attributable to intercompany balance, which is only between the parent and the subsidiary. What that means that invariably, if this is 9, the result will have been 9 minus 8. Plus 0, and 9 minus 8 plus 0 will have given us 1 here. I will show 1 as a balance as dividend receivable 1. And what that 1 represents is simply put, it represents dividend receivable from other investments that is not a subsidiary. Which means you don't just pick what is here in the balance sheet and say it's intercompany. You must always carry out this analysis to identify from the perspective of subsidiary, what portion of dividend is due to the parent, and it is here to be paid. And that constitutes an intercompany balance. And that's what we are talking about here. Now, in this case also, we still have 20 and 10. 20 is that of the parent payable to his own shareholders, and 10 is that of subsidiary payable to his own shareholders, of which we are to eliminate 8 payable to the parent, so that what is left is 2 payable to non-controlling interest, which will consolidate with other dividend payable to constitute dividend payable by the group to all of its external shareholders. And the external shareholders here comprises of all of the shareholders of the parent plus the non-controlling interest, who are other shareholders in the subsidiary other than that of the parent. Okay, now let's continue our process here. Our post-acquisition profit here is 20. Now, what's our purchase consideration? Is 100 as updated. Our ordinary share capital of Adebola is 100 as updated. Our pre-acquisition is 40. Our kind amount is 140. Now, upon measuring NCI, we measure it at 20% of 140. And that's how we have 28. And if you check, this 28 is 20% of 140. Okay, and of which we share post-acquisition profit, which is 20% of 20 to the non-controlling interest, which make up this form, as you can see here. And we also share 80% of 20 to the parents, which make up this 16, as you can see it here. Now, that gave us this position. I remember the retained earnings of the parent is still 140, which is here. Okay. Now, what then do we do? We now have negative goodwill here as against positive goodwill. And who can remind me, what treatment do we give to negative goodwill? What treatment do we give to negative goodwill?
We add it to retain as
Therefore,
profit.
as a gain, we treat it as a gain on bargain
purchase,
which we add at acquisition to parent, which means in this case, there's no goodwill. In this case, there's no what? Goodwill. Let me strike it out. Therefore, I can put this formula that at any point in time is the minimum of is 0, and whatever the value is, such that when there's no goodwill, it shows me, sorry, maximum of 0. So that at any point in time when it's negative, it shows me that there's no goodwill. And that's the position I'm adopting here. Therefore, in this case, there's no goodwill. I need not show it. And if you want to show it, you can also show it. Okay. Now, that means that here I have to recognize gain from bargain purchase. I can link it here. And what is that? I can also link it as a formula and say the minimum of is 0 and this, and I can multiply it by negative to convert it. Therefore, which means whatever it is, it can always be oscillating between goodwill and gain. Okay, what I'm trying to do here is this. As you can see that it's showing 12 here. If peradventure, let me change this thing and put this to 120. You see that it's now positive goodwill. It will show up here and it will show 0 here. That is the power of modeling. Okay. Now, which means invariably, I come here to reflect it. Now, let me pick it one by one. My PPE is now 130. Property, plant, and equipment is 130 and 120. 130 and 120. What does that sum up to? 250. My inventory is 25 and 45. And 25 and 45 is 70. My trade receivable is 12, 12. And that's 24. I think I didn't update it here. This one too is 12, 12. Okay. I've dealt with dividend receivable. My bank is 57. That's 12. Okay. Share capital is 80. Retained earnings is consolidated as we have it here. NCI is already done at 32. Trade payable 4014 is 54. And dividend payable 2010. And we have eliminated 8 to give 22. When we sum this up, it's 76. And that gives us our position once again. Regardless of the position we take, we always arrive at our final destination, which is appropriate. And this brings us to the end of group adjustments. There are one or other adjustment also you can read up in the material, which may not be relevant to our discussion now. It borders on what if subsequent to acquisition, the subsidiary declare bonus shares. How do you treat bonus shares? Remember, it's not going to change the percentage ownership of shareholders, including that of the parents, and neither shareholder will be bringing out money. Which then means that how do we now treat bonus issues in group accounts? Okay, you can read that up in the material, and when time permits in the immediate future, we can look at that as one of those adjustments in group, which is only one of in most situations. Any other question? Any other question?
No question.
No question from me.
Okay. If there's no question, you go back to the material and check off for one or two other questions there that we didn't touch, but we have dealt with the principles. And you can use that to have a better appreciation and understanding of what we have discussed so far. Therefore, in the absence of no other question, thank you very much. And I'll make this worksheet again as updated now available to you. And we'll discuss on other aspects tomorrow. In the next section, we will be talking about how do we account for investments in an associate, and also how do we account for investment in a joint venture. And before then, we'll evaluate what constitutes an associate, and we also take time to look at the requirement of IFRS 12 and IFRS 11. IFRS 11 specifically speak to joint arrangements, and IFRS 12 speak with disclosure of interest in other entities. Okay, that may constitute subsidiary, associate, joint venture, or other simple investments. Thank you very much, and God bless you. Bye.
Thank you, sir.
All right, thank you, sir.